Hi Pradipta, hi Varun, welcome to the event. I'm Ananya, I'm one of the heads of this event. So glad to have you here.
Hello, Ananya.
Yeah, so just I think we can have a quick introduction and then we can start the event. We'll be starting at 10:15 sharp.
Hi, Pradipta, sir, you're there? Hello. Am I audible, Varun?
Yes, you're on.
Okay. I don't know if sir is there or not. Then we could do this somewhere in the can we begin now? So it's 10:14. At sharp 10:15 we'll begin, and then we'll have 15 minutes.
Sorry, guys, I was off the desk for a sec. So shall we start now?
Yeah, at 10:15 the first team comes in,
Okay,
and then we'll have
good.
15 minutes slot.
Good.
And just the first team. So the first team we'll just call them at the end because they had
Yes,
an
sure.
academic commitment, so they'll join at the last. I don't know if sir is there or not. Then we could do this somewhere in the middle. Can we begin now? So it's 10:14.
Yeah, let's start when you guys are ready.
Yeah, okay, sure. We'll just start in a minute.
Also, please remind the teams of this 10-minute slot. So it will be a call out at the end of 10 minutes. So even if it is in the middle of the presentation, it will be stopped.
Okay. So actually we'll be ringing two bells for them, one at the 5-minute mark and one at the 8.5-minute mark.
Sounds great.
Okay. I'll admit them and then we can stop. Hi, team 43. You can start with your presentation. You have 10 minutes and we'll be ringing the bell twice, one at the 5-minute mark and one at the 8.5-minute mark.
Could you please allow screen sharing? Yeah,
I've turned on the settings. You can go on.
yeah, thank you. Good morning, everyone. Here we are, team number 43, presenting our hypothesis for QuantInsti efficiency of price action trading strategy in context to Indian equity market. Our hypothesis is bullish and bearish engulfing on India VIX is effective on Nifty future since both being negatively correlated. Coming to India VIX, it is a volatility index that indicates the degree of volatility. In the strategy, we use bullish and bearish engulfing for Nifty 50 future to observe uptrend and downtrend. As you can see in the image on the left, India VIX and Nifty 50 future are reacting opposite to each other. For entry and exit signal, we use engulfing pattern visible in the right image to identify the reversal position and make our call to enter the trade. Moving to the stock selection, we had two options, either to go with individual stock or the index. But on observing with the individual stocks, we figured out that it doesn't react oppositely to VIX as seen in the case of Nifty index. For example, here we have an example of Axis Bank, and we can see that it is not reacting opposite to India VIX in certain cases. Moreover, we particularly use Nifty futures and not Nifty index because of the fact that the index doesn't allow short selling in Indian market, and that would cut down half of our trades. Also, as seen on right, the future and index price is almost similar, so it is a good alternative to in Nifty index.
In our strategy, we observe bullish and bearish trend along with reversal candlestick pattern on India VIX and take the complementary position on Nifty 50 futures. We have used SMA, that is simple moving average, with a look back of 10 candlesticks to detect trends. If price is below SMA, it is bearish and bullish in the other case. Our buying and selling is based on the deduction of engulfing patterns. Engulfing happens when a small candlestick is completely engulfed by a larger candlestick. When the small candlestick is red and the larger is green, it is bullish. While if the small candlestick is green and the larger is red, it is bearish. On the left, we can see a code for detecting bullish and bearish candlestick on VIX, and then we take the complementary, that is the opposite position in Nifty future.
Okay, now we'll answer the question why we only chose bearish and bullish engulfing candlestick pattern and not other type of pattern. Okay, so now logically, since it's a two candle pattern, it is more frequently encountered. And second, it also proved to be among the most efficient two candle patterns in terms of accuracy and frequency, as mentioned in Encyclopedia of Candlestick Charts by Thomas and Hulkowski. Now we also tried with other candlestick patterns and chart patterns. Some of the candlestick patterns we tried with were Marubozu and Hammer, Hanging Man, Morning, Evening Star, etc. We have mentioned some of the results in this table. Okay, we also now tested with chart patterns like inverse head and shoulders and triangle and double top, double bottom. So we have mentioned the code and logic for inverse head and shoulders in the appendix of our report. And other types of patterns like triangle and double bottom can be just made by small modifications in the code for the head and shoulders. Okay, so now we come on to the risk management measures. So first risk management measure is a smart stop loss. So this is a kind of stop loss that will vary with time during the trading hours. Initially, it will start with a high value, and then as the market ends, it will decrease. This is so because during the start of the day, market is usually volatile, and as we go ahead with the day, we actually see the market being less volatile. And one of the reason why, okay, so we also see market volatility during the very end, but since we do not have time to close our position in the end of the day, we also keep the stop loss less. The second risk management measure is take profit. We have kept the take profit to be 0.1%, which we found a good negotiation between to keep our risk reward ratio high. Okay, so now we come on to the assumptions. So these are the kind of transaction charges we assume while we while we trade. So brokerage, STT, CTT, transaction charges, GST, SEBI charges, stamp charges. We keep the slippage to be 0.00046%. Okay, so this is the example of transaction costs that we encounter. Now we come on to the results. These are the results for a 3-year period with the trading frequency of 1 minute. We can see the cumulative returns to be 100%, annual returns to be about 26%, and we can also see the stability of time series to be 90%.
Moving on to the hypothesis testing. We have two time series, one for Nifty futures and another one for India. Our hypothesis is that they move opposite to each other. So here we have plotted the day-wise data for Nifty 50 index and India VIX on a double scale curve. First, we'll prove the causality, then their opposite movement, and finally whether the profit generated is statistically significant. So first we have to make sure that the two series are stationary. So we assume the null hypothesis that they are stationary and alternative hypothesis that they are not stationary. So doing the ADF test, we find that p value is greater than 0.05 for both, so they are not stationary. We then use the difference method to convert them to stationary series. We then verify this by applying the ADF test to the new transform series and find that the p value now is way less than 0.05. So they are now stationary. We can you go back a slide, please? We now use the Granger causality test to establish whether one time series is useful in forecasting the another one. So looking at test results, we see that p-value for predicting Nifty using VIX is 0.03, while for Nifty predicting VIX it's only 0.08. So using a significance level of 0.05, we conclude that VIX series causes Nifty time series to move, but not the other way around. So Nifty does not cause the VIX to move. We now use Pearson correlation coefficient, which for this case is found to be minus 0.17. It proves that both are negatively correlated. To show a stronger statistical significance of our opposing time series, we would now use t-statistic, which is calculated using mean and standard deviation of estimator, which in turn was calculated in Excel using the transaction logs of our 3-year period backstep, which was obtained from Blueshift. The t-statistic obtained is 2.34. Using the t-table for very high degree of freedom, we obtain an alpha of 0.01, which gives us a confidence interval of about 99% on our one-tailed hypothesis.
So now we move on to a custom-defined risk metric that we have developed to judge our strategies. It is named as the goodness factor, and it is expressed as 2 times the return on maximum drawdown plus 1 times the Sortino ratio and 0.5 times the omega ratio. So now, according to this goodness factor, a decent strategy would have a score greater than or equal to 4.55, and a good strategy would have a score of greater than or equal to 7.6. So now, while calculating this minimum threshold, we have assumed some standard values for the underlying ratio. For example, for a decent strategy, we have assumed the return on maximum drawdown to be 1.5, Sortino to be 1, and omega ratio to be 1.1. Next slide, please. So the natural question that arises is that why are we choosing these ratios, and what's the criteria for the weight application? So firstly, why did we choose Sortino over Sharpe? So the Sortino ratio takes into account only the downside risk of an investment as compared to Sharpe, which considers the overall risk while calculating the risk. The upside risk is actually relatively harmless. That's why we use Sortino to differentiate between the harmful and the harmless risk. Now, omega ratio is another ratio which we have used. It is a measure which captures the skewness and kurtosis of the time series of returns, which is not indicated by most of the other ratios. So ideally, we would like our strategy to have a low kurtosis and positive skewness. So then weight allocation, previous slide. So in our calculation for goodness factor, we have assigned a higher weight to return on maximum drawdown. So this is because we want a metric that captures the returns when we are able to generate against our highest capital loss. So, for example, if a $100 portfolio faces a drawdown of 50%, the strategy would have to make 100% returns to regain that capital. So ROMAD is an important ratio that should be assigned a high weightage. And omega ratio is assigned a lower weightage because we have assumed skewness and kurtosis to be secondary factors to judge our strategy. Next slide, please. So now what we have done is tested our pattern on 1-minute candlesticks. But by entering into multiple trades, we are increasing the brokerage charges and transactions costs that are incurred. So to remove this noise and to decrease the trade frequency, we tested our strategy on multiple trading frequencies to see whether this return can be continued over different time frequencies as well. So, and also in order to test the robustness of the hypothesis, we divided a 3-year time frame into 12 periods of 4 months each, and then judged it using the goodness ratio that we have defined previously. So we can see that with a trading frequency of 10, we are able to get relatively better results than other frequencies if we compare it using the goodness factor. Next slide. So now now let's discuss why our model could fail. So in the hypothesis testing which we did, we assumed a daily time series data of India VIX of 50.
So thanks, guys, for your presentation. So it's a really good effort from your side. So you have your basic hypothesis is that engulfing pattern along with VIX works, right?
Yes, sir.
So you tested a strategy based on this. So what will be your alternate hypothesis? You know how we do hypothesis, right? So you basically assume that H0 is true, and then generate data and see that whether we can whether H1 is there any evidence for H1, right?
Yes, so alternative hypothesis would be that it does not work on it, and the return that we get is like purely due to randomness.
Okay. So the problem in our case is that you might be in some very strong bear markets or bull markets, right? So
Yes,
even
sir.
if you trade randomly, just because everything is going up, your return can be positive,
Hmm.
right?
Yes, sir.
So how we take care of that? So for example, in the T statistics you computed from the round trips, if you randomly pick some stocks and you are in a bull market, it will be very strong. It will be a very high T value. You get the
Yes,
point, right?
yes, sir.
So how do you think we can counter this?
Okay, sir. So in this, I think we can divide what we have done is similarly in other cases as well. We can divide the time period into like sub time periods and like check it for individual time period whether the t value is significant for that period as well. Like subsample from those from the population to ensure whether it is significant for different time periods as well. That's okay.
Okay, sounds good. Thanks, guys. Thanks very much for your part. Can you have the next team, please?
Yeah, sure. So the next team is team 55. So you can start your presentation. There will be two buzzers, one at the 5-minute mark and one at the 8.5-minute mark.
Okay, so good morning, everyone. I am Ayush from Team 55, and I'll be sharing a strategy on the efficacy of price action in the context of Indian equities market. Now, the first pointer that comes to our mind is what should our universe be in context to any strategy, like what stocks should we trade on. In this strategy, we have selected Bank Nifty futures as our universe because Bank Nifty has sort of shown all type of price trends in the past 5 years, you can say, be it trending or reverting in nature, or be it a random walk per se. The stocks of this index have also been a prominent constituent of the most traded stocks, and the index is sort of highly liquid in nature. So it sort of reduces the slippage as well in our strategy. Next slide, please. Uh, Here would be a brief overview of the strategy that we are going to perform. So first of all, we would like to classify the price action or the price series using Hurst exponent into three categories, whether be it trending or reverting or a random walk. And now based on the nature that we have found out, we will be producing two alphas. First alpha would be for the reverting strategy and second alpha would be for the trending series. We won't be trading on a random walk because we could not classify the price action in that range properly. Now my colleague Tanmay will take on from here to explain what is Hurst and move forward.
So let us begin with the Hurst exponent. The Hurst exponent is used to access the rate of diffusive behavior by the variance of a log price series. So here we can look into the formula of Hurst exponent. So in the case of a random walk, the variance of a log of price series is linearly related with the time lag which we are taking into consideration. So by the definition of Hurst exponent, here the twice of h will become equal to 1 and the h will be 0.5. But if the time series is not random, then there exists autocorrelation in the time series, and this linear relation modifies and becomes related with lag raised to the power 2h. So if the log of variance is now lesser than 1, then 2h becomes lesser than 1 and h becomes less than 0.5, and the series is mean reverting in nature. So in that case, we are going to apply a reverting strategy, which in our case is the z-score slowdown hypothesis. If the log of variance, next slide please. If the log of variance is greater than 1, then the twice of Hurst exponent becomes greater than 1 and h becomes more than 0.5. So in that case, we are going to apply a trending series, which in our case is the nearest neighbor strategy. So now my teammate Divij is going to explain us about the z-score slowdown hypothesis.
Now is the hypothesis for reverting series. This strategy is for reverting market that trades on outliers. Let's take an example of State Bank of India candlesticks graph. As observed graph, we can see whenever we get excess returns in last 2-3 minutes as compared 1 to 2 hours, then the series seems to take a reverse turn in the prices. Similarly, whenever we get excessively low returns in last 2 to 3 hours, as compared to last 2 to 3 hours in the last 2-3 minutes, then the prices seem to take a upper turn. So hypothesis, Z-score slowdown hypothesis. Whenever the our Z-score is greater than the 60th percentile, the mean Z-score, then we will take our short position. Whenever the Z-score is less than the 40th percentile, then we will take long position. The algorithm for this is the return is equal to close minus open, and Z-score is return minus rolling mean by standard deviation, and slowdown is the mean of last 3 minutes, and signal is the negative of slowdown.
So as I stated earlier, in the case of Hurst being 0.5 or closely 0.5, we will not be making any strategy and we will not be trading in this period. And we will sort of further like to move on to the trending part, or how we can make sure that our trending strategy also works. So in case of trending market, we will be taking a nearest neighbor based sort of nearest neighbor based sort of improvement in that algorithm, wherein we will be taking the weighted majority vote of the nearest candlesticks to the current candlesticks on, say, some distance measure or distance metric. As seen in the graph here, you can see that the last candlestick is bullish in nature, and the overall market or the trend is also bullish in nature. But the previous stick to the last candlestick is sort of falling downward, or you can say it is bearish. So to handle this, we would be sort of introducing new derivatives based on the candlesticks, which would be our market spread, our market width, and an on balance volume based indicator. And comparing and using these three values, we would be comparing the candlesticks, and we will be taking the harmonic weight mean, so that to get the final sign or to get the final direction in which we would like to move our assets. Now, another aspect of our strategy is the risk management or portfolio sizing part, and Swan will be taking on from here.
Swan, you're muted.
Yeah, we have started with average true range, which is the volatility indicator for us. We have used it as the fluctuating price in the time period of given 14 periods. We have used 14 time frames for this. The calculation of ATR is already visible on your screen. The formula is already stated. So yeah, we have used ATR for the risk management part. Next slide, please. So we have used ATR for the risk management part. Using ATR, we have divided into 4 different buckets, mainly on the basis of a percentile in which it has occurred. When ATR value is so low, as volatility is low, as well as the trading of all asset is done, all the assets are trained. However, in the later part, in 25 to 50 percentile, we have traded just 0.8% of the total asset, which is due to the high volatility and higher risk as well. Similarly, we have traded 70% and 60% in the later 2 quarters as well. So now moving on.
Hello. Can you please roll back? Okay, so in here, what we will be doing is based on the volatility, we will be introducing 4 quantiles. And based on those 4 quantiles, what we will be doing is we will be trading our assets proportionately or accordingly. In higher volatile regions, we will be trading lesser assets, and in lower volatile regions, we will be trading more assets, so that we can reduce the slippage part as well.
Yeah. So coming on to the results that we have got, moving on, we have got the cumulative returns of 156%, which is probably a very good as compared to the benchmark, which is visible on the screen. We have also managed to reduce our drawdown to 17%, which is also considerable. Now going on, we have seen that the time series has been 95% stable, but due to time constraint, we haven't been able to develop our model or improve the performance of our model. But meantime, we have increased the leverage to 2x, which means that we have increase the cumulative returns to over 500%, and also managed to maintain the time series stability to 96%, which is a good metric. Now moving on, we have transaction log snippet on your screen, which is clearly visible. We have used 5 minutes as our time frame, which is visible on your screen. The reason behind this is using 5 minutes means that we can have maximum 70 to 75 trades a day, which helps us to remain in that guideline, which was mentioned, having maximum 100 trades a day. Now moving on. Yeah, so obviously we can't create a strategy which would work in all the kinds of market in all states. So yeah, we have some pitfalls for us as well. The strategy that we mentioned, especially the Hurst exponent, it won't be performing well when the shorter durations are considered. That is when we are taking positions for shorter durations. Moreover, the trending signals, that is the nearest neighbor algorithm, would perform poorly when we consider the number of neighbors is less, which is the value of n is less. And also the trending strategies gives less number of signals compared to the reverting strategies, which means the amount of profit generation in that state would also be less. Yeah, thank you. That's all from our side. We are open to questions.
Thanks, guys. It's a great effort. Varun, do you have any questions?
So yeah, like I just want to ask them, like, how can they justify using Hurst exponent to select if it is trending and then pick nearest neighbors of 9 candles? Because we're calculating the trending part, they used a longer time frame. Just want to understand the thought
Sure.
process.
So while calculating Hurst exponent, we won't be taking just the last 9 candles, you can say. Hurst exponent would be calculated on a longer period, say last 1 hour or 2 hour based 1 minute candlestick pattern. And based on that, we will be classifying our market, whether it would be trending or not. As you can see, Hurst exponent is 0.5 in the case of a random walk, or in that case, the price series is sort of linearly related. The variance of price series is sort of linearly related to the time lag. But when there is sort of some skew, or when there is some bias for a side, the Hurst exponent sort of changes accordingly as well. So the Hurst exponent part, to clarify, just would be calculated on a longer period, say 1 hour or 2 hour. And based on that, we will be classifying our strategies into either trending based or reverting based.
Okay, so the final nearest neighbor calculation would also be on hourly, or would it be on a shorter time?
It would be like it won't be on a shorter time. We have used 60 minutes rolling data for each and every calculation. Just the thing is in the final nearest neighbor, we would be taking only the 9 of the closest neighbors to the current candlestick pattern. And we won't be taking it on the basis of OHLV, but sort of rather the derivatives we have introduced.
So basically you're calculating sentiment in the last 9 candles to decide whether to go long or short.
Not the last 9, but the nearest 9 to the current candlestick.
Yes. Okay. Very good. Pro, have any questions?
Yes. So before there's any questions, just one clarification that this competition is not about creating strategies that makes money. Okay. So optimizing, reducing drawdowns, and all those things are not important at all from the point of view of this competition. So it is very clear what is your first hypothesis. You say that there is a short-term mean reversion based on Z-score. Am I right?
Yes.
Okay. This is not a price action related hypothesis.
Actually, when you say Z-score, it can be sort of confusing. But what it is simply indicating is that if there is excessively high returns, or like say outliers in the current market based on the price action, say in here, if
you
there
are
are
computing Z-score as the
of close minus open, you can say the sort of deviation in the candlestick or the width.
You are computing Z-score as mean of past returns divided by the standard deviation, right?
Right.
That is not price action. We shared the definition of price action, I think. So this is not price action. The second part, the nearest neighbors, that looks more like price action. Okay, but there it is not very clear what is the hypothesis.
Hypothesis would be sort of based on the trending nature of the market. We would be sort of so based on the we have already used that the market is trending in nature. So based on that, we would like to know the current state that the market will be going on, or what the trend is. And
No. So the hypothesis should be like you have stated for the Z score, right? You say that the Z score less than something, we have a chance of making profit by going short. Otherwise, we have a chance of making profit by going long, which effectively implies that your hypothesis is there is a short-term mean reversion in the markets.
So we have
What
sort
is
of
that
introduced the
statement
final
here?
signal.
What is the statement here for this trending market nearest neighbor thing?
So we have sort of introduced our final
It
signal,
will
or
be a
say
statement. It will be a statement.
So the statement would be ki if the final, if the weighted harmonic mean of the signals of the closest 9 neighbors is positive, then we will be going long. Otherwise, we will, if it is negative, we will be going short.
And for this neighbors, nearest neighbors, the distance matrix, the coordinates that you are taking, none of them are stationary series. You have the concept of stationarity and non-stationarity.
Yeah.
So do you understand that they are not stationary? So over time, those numbers will go up.
So to counter that, we have sort of scaled those numbers in between 0 to 1 as well.
Oh, that's fine. That depends on your sample. So that is actually doesn't make it stationary. It's just scaled. Okay. But overall, it's a very good effort. And when you are, so I asked these questions to the last team also. So when you are trying to say that my strategy works, or this signal works, so you cannot just taste that signal and say that it is making money, that's why it works. Because as we mentioned, that there can be some bullish or bearish trends in the market that will make any random strategy also to work. So you have to prove that my strategy works and a random strategy doesn't work to prove your or to reject the null hypothesis. Okay, thanks guys. Can we move on to the next one?
Yeah, sure. The next team is team 25. So you can start sharing a screen, and we'll be ringing a buzzer at the 5 end mark and then at the 8.5 end mark.
Hi, I'm from team 25. Am I audible?
Yeah, you're audible.
Okay, I'll just share my screen.
Yeah, sure.
Sorry, just give me 1 second. Sorry, not one. Give me 15 seconds.
Sure. You can start presenting a screen in meanwhile. Just set it up.
Yes, let's resume. Apologies.
Yeah. So your screen is yeah, you can start the presentation, team 25. Your presentation is not visible, I think.
Is it visible now?
Yeah, you can start.
Hello, am I audible?
Yeah, you're
Let's confirm. Okay. So when we received the problem statement, we decided to research on what exactly price action strategies were. While discussing, we came upon the idea of evaluating candlestick strategies and which ones actually work in the Indian stock market. Our intuition was that for candlestick patterns that showed reversal, that they would be most suitable for stocks that were liquid. Given the constraints of the problem statement of long only trades, we narrowed down our focus to bullish reversal candlesticks, and thus we formed our hypothesis. In our report, we have discussed two ways of evaluating the effectiveness of reversal candlestick strategy. The first being the return on stock, with the null hypothesis being that the average return of signals in stocks with high liquidity is negative, and the alternative being that it is positive. The other hypothesis focuses on the winning probability, that is, the number of times we have positive returns on selling the stock we had bought. The null hypothesis states that the winning probability of signals in stocks is less than half, while the alternative states that it is false. So the next idea. How do we select what stocks we want to evaluate? Given the differences in market capitalization of stocks in NSE, we also decided to separate our evaluation on small cap and large cap stocks. As per our literature review, we decided upon the Amahed illiquidity measures to compare stocks and select the ones which were least illiquid in the indices. We calculated these on the basis of the data from July 2018 to December 20. Now, onto the strategy that we use. Our strategy of evaluation and running on Bluetooth was fairly straightforward. We would detect the candlestick pattern in question out of bullish engulfing, bullish surrounding, and bullish piercing on minute-wise data spanning 3 months, Jan 2019 to March 2019. We would confirm the reversal strategy with the exponential moving average trend indicator. If confirmed, we would enter the market on the next candlestick. Now, we don't know when the reversal would take place, right? Hence, we employed the M/R strategy, in which we held the stock for a particular number of minutes, in our case, 1, 5, or 10 minutes, and then we would exit the market. Talking about the risk management tools that we employed, the standard commission of 20 rupees can be ignored as our return calculation is dependent on prices at entering and exiting the market rather than absolute values. Talking about commission and slippage, talking about slippage and stock loss, slippage has been ignored because the stocks that were chosen were highly liquid. So in normal market conditions, it was highly probable that the order would get placed quickly, resulting in non-significant slippage. The stop loss, we decided not to use the stop loss because the minute-wise data did not show such significant differences such that we would actually have to employ one. And even the holding intervals that we were using, 10 minutes, they were not too large. So on to the next slide, where we discuss the bootstrap skewness test. Now here, since we are not following the assumption that our data is stupid, the data is assumed to have some degree of skewness. Therefore, skewness adjusted t-test is to handle bias of return and the test for profitability of candlestick pattern. A bootstrap sampling is performed in order to find the confidence interval to test whether we can reject the null hypothesis or not. Now, as you can see from the box plot, using engulfing patterns having holding period 1 and piercing patterns having holding period 1 and 5 minutes, we are able to reject the null hypothesis. Now, in order to investigate the predictive power of candlestick patterns, a binomial test is performed. Now, here the NP naught is the expected number of success and C naught is equal to 0.5. Now, in our case of empire exit strategy that we have employed, the winning probability is here the positive holding period returns for a bullish signal. Now, to test the null hypothesis, the Z-score and confidence interval is calculated assuming the normal distribution, considering significance values as 90, 95%, and 99%. Now, here we found that we are able to reject the null hypothesis for certain patterns for 1 and 5 minute holding.
Vineet, you're muted if you're speaking.
Hi, sorry. This study aimed to evaluate the effectiveness of bullish reversal candlestick strategies on liquid stocks of NSE Stock Exchange. The idea behind the hypothesis is that the highly liquid stocks should show significant results on these price action strategies, but none of the candlestick pattern had significant outcomes to reject the null hypothesis in the large cap liquid stocks. However, there were some notable outcomes in the small cap liquid stocks. Uh, among the liquid stocks, the three candlestick patterns, Harami failed to produce any significant results in any holding period, but the piercing and the engulfing candlestick pattern showcased earlier, showed significant outcomes in 1 minute and 5 minute holding period, but again failed to reject the null hypothesis in 10-minute holding periods. So overall, the piercing candlestick pattern is recommended to use in the small cap liquid stocks with 1 minute or 5 minute holding periods. Thank you.
Thank you. We now open the floor for questions from the
Okay,
panel.
it's a very concise, stated hypothesis and a very well designed test for that. Just for my clarification, when you are computing the return, you are generating the signal, noting down the opening price, that is your entry price for that trade, and you have a fixed holding period, and you're computing the return based on the holding period return. Is that correct?
Yes.
Okay. I think your project has achieved what it set out to. One thing about your results, do you have any comments on the results? So you see that for large caps and for small caps, there are some differences, right? And also for holding periods, there are some differences. So do you have any comments on that?
Yeah, so we believe there is a confound variable which depends upon the market size. Like there is a confoundness basically, which
Which
depends
one
upon the
is the confounded variable?
the market cap of
Okay.
the market cap basically, which we need to which we can explore by further testing upon other parameters, uh, by uh, by applying some regressions or uh, uh, like as a part of a further studies we can apply regression etc to to identify the contribution of the market cap kind of thing, by segregating into several groups, like not only large cap and small cap, but we can expand over different market caps, and study the exact uh, approximate contribution of that variable.
As for the holding period, so as we saw that 105 statistics are more effective, we can also, we can also comment that the candlestick pattern is better for a shorter period. It only shows reversal in the shorter period, but as we do not have the data, so there was a lack of data, so if we could examine further, we would have to conduct more tests on that. But yes, 1 minute and 5 minutes have, I think, throughout the results were performing better as compared to 10.
And how you have used Blueshift for generating these returns?
So basically all the transactions, so we coded the entry by detecting the candlestick patterns and the downtrend on the blue shift, uh, and we ran the strategy for all the 18 combinations mentioned in the table, if you can see in the report. uh, and for each backtest we downloaded the transaction data,
Okay, got it.
and then
And why you haven't done it for all the candlestick patterns, just for three? Because of time.
pardon.
Why you have just restricted yourself to 3 patterns in candlestick, not all of
Yeah,
them?
actually,
Because of
yeah, we
time?
were, yeah, because of time, and mainly like the platform was not available for all the time.
Yes, we
Like,
had some serious outages in the platform.
yeah, yeah. So we had to
And
constrain over the our
Okay.
and we considered mainly reversal patterns, so the major reversal patterns are considered here.
Okay. Varun, you have any questions?
Just want to understand why they didn't use stop loss, especially trading with candlesticks or designing some strategy with candlesticks.
That's a very good question. If you are using statistics to prove your hypothesis, stop loss actually can interfere with it.
yes, because like when we are, because it will not show, like it will reduce the winning probability, like because the returns will not be the true negative prediction of
The
uh
returns will be not under the assumption of null hypothesis. It will
yes,
be some
yes,
other distribution, shifted.
yes, yes. Mm.
Good work.
Okay, I think that's good. Thanks, guys, for your effort. We can go for the next one, but just 15-20 seconds I need before that.
Sure.
So we can leave, right?
Yeah.
Thank you.
Thank you.
Team 49, you can start sharing a screen meanwhile, and we'll start as soon as Sir is here.
Yes, ma'am. Am I audible?
Yeah, you're audible.
Okay. Is my screen visible?
Yeah, it's visible.
Oh. So, ma'am, can you just give me a go ahead and I can start?
Yeah, sure. Just wait for a few seconds.
Okay, sure.
Sure, let's start.
Yeah. So, firstly, like the rest of my team members, currently we're having exams going on. So, I'll be the one presenting the strategy today. Like they are in the 4th year and their exams are going on right now. So, I'll be conducting the entire presentation. Yeah, the first part of the presentation is about our hypothesis. One second. Yeah. So the main hypothesis that we came up with was related to mean reversion and
Sorry,
momentum.
this is team 43, right?
Team 49.
49, okay, sorry. Yeah,
Yeah.
go on,
So
please.
should I go on? Yeah. So the main idea behind our strategy is related to mean reversion, and also there's an element of momentum-based indicators that we've used. So to identify the levels where we kind of enter trades, we also use the support and resistance levels, and I'll explain how we are using it. So the main strategy is that we'll assume that the market follows mean reversion, and we'll enter and exit trades on the basis of our identified support resistance levels. So yeah, this is just a little background about mean reversion and and support and resistance. What we observed is that for volatile stocks, we can, in the short term, we can say that they will kind of return to their moving average, and that return is triggered at their support and resistance levels. So if we can kind of identify where those levels are with high accuracy, we could make like profit from the trend that is from the support to the resistance level, and we can exit trades at the resistance level. So that's the basic idea behind our strategy. So I don't think I need to explain mean reversion. Like this is just like that.
No, please go ahead.
Yeah. So how did we choose our stock? What we observed is that in trending markets, it's difficult to identify like mean reversion in short term. So we went for volatile stocks, and we identified those using this metric. The metric we used was the ATR, and we chose a 50 largest stocks on the NSE, computed the metric for all of them, and chose the top 10 stocks. And some of our stock selection is here below, like Maruti, Dr. Reddy's Labs, Bajaj Finance, and all. So the reason we took large cap stocks is so that we could actually make some kind of conclusive statements, because the volumes are large there, and it's kind of better to have a hypothesis with large cap stocks, because it can be a little more conclusive as compared to others. That's why we chose them. Yeah. So how did we identify the support and resistance levels? We used a basic regression model here. So to identify the support levels, we took note of the past 20 days of high prices, and fit a linear regression model to that. From that model, we then predicted what would be the next day's support level. Similarly, we did that for the support levels as well, and these became our entry exit points for the trade in the current trading day. So you can see here that we haven't used any future data, so there's no look ahead bias here. We're only using the past 20 days data. Also, that this is not dynamic, and our best fit line is shifting every day. So yeah, this is how we use regression while predicting the price action. Yeah, I think I've gone over this part. So we also, yeah, the best fit line of support. Next, to kind of make the signals a little stronger, we didn't want to just enter and exit on the basis of our predicted support and resistance. We wanted like stronger signals, so we also used some amount of technical indicators in our strategy, and they were basically to help us identify whether a particular trend was strong or weak. And the reason why that matters is here. So in the case of a strong uptrend at a resistance level, we can kind of confidently say that the reversal might not happen over there. So maybe we should hold on to our securities a little longer and profit from the trend. But if there is a weak kind of trend at a resistance level, we can preemptively say that there might be a reversal, and it's better to cash in at the resistance level itself. Analogously, for support levels, we can say that if there's a strong downtrend, which means that it's probably the market is probably going to go a little lower, and we could wait for a while to enter before entering any trades. And a weak trend implies that there could be a reversal, so we should enter the market at that point. So we use RSI and moving averages to kind of determine the trend of the market. So the kind of the conditions we used is that RSI value is greater than or equal to 65 means that the market is overbought, and that there could be an that it is indicative of a reversal or like a selling situation. Similarly, when RSI is less than equal to 65, we can kind of preemptively say that there might be a uptrend following soon. Similarly, when the short-term moving average crosses the long-term moving average, we could say that an uptrend, it's the beginning of an uptrend. And conversely, when it crosses from above, we can say that there's a downtrend. So using both of these indicators in conjunction kind of gives us a feel about the momentum in the market. And the final strategy can be made using all of these elements. So whenever the price of the current day breaches the predicted resistance level, and we observe a strong uptrend, we can increase our position size, because there might be a further trend in the stocks, uptrend in the stock. A weaker trend implies that there might be a reversal for a volatile stock, and so we should clear and cash out. And if there is a stronger downtrend and the price breaches the support level, means that there's going to be a further fall, and we should clear existing positions and not enter new positions. Basically, we should wait till we can get securities at a lower price. And if there's a weaker trend and the price breaches the support level, we could now enter trades because we are kind of expecting a reversal. So that's the strategy that we came up with. And this was related to the pitfalls and improvements that we could have. So like I said, we didn't have any look ahead bias because we were not using any future data to optimize future decisions. The problem with the current indicators is that they could be lagging because they are dependent on the past data. And we can solve that by making stronger signals, maybe perhaps using more indicators. Another improvement that we could have is making a better predictive model as compared to linear regression, possibly with a larger set than just 20, like the previous 20 days. And also right now our allocated percentage of the portfolio for a security is at 15%. We could be keeping this dynamic in case we want to profit from stronger trends. So that's it from our side.
Okay, I think just a reminder that this project was not about finding strategies that makes money. This project was about testing hypotheses.
Yes, sir. So the problem with that is that we've coded the entire thing up, but we were not able to get the work done on Blueshift because the server would not respond to us. Like we tried that multiple times. I think we
So that
mentioned
is
that in
fine. So it's not a problem. So Blueshift has some outages, but if you share the codes, we can run it for you and we can check your conclusion.
Yes, sir. So that we've already shared within the report. And like that's the reason we could not conclusively like analyze the hypothesis because we were not able to backtest it properly. We have the code and everything ready,
Okay,
but
sure,
we were
not
not
a
able to.
problem. We'll check it for you. Do not worry about it. So can you go back to your support and resistance computation?
Yes.
You had a chart for this, a plot. So which one is support and which one is resistance?
So the lines on top would correspond to the resistance line, and the bottom.
And how the top line is drawn here?
So we basically analyze the higher highs, like the highest highs among in the trading
So your
interval.
report says that you have taken the highs for the last 20 days and ran a regression. Do you think we'll get that line if you do that?
So this has a different time period, so probably not. But
no, means if for any time period, if you take the candle highs and run a regression, do you think you will get similar kind of output?
No, we won't get a perfect connection between the highs. There will be some amount of error there, but
so
I
there
mean,
will be a large amount of errors. So for
there
example,
would be errors there.
It will be nothing like support or resistance.
Yes, sir, but I think that's important.
It will be something like almost fitting a line through the price, because the highs and the lows over many days are very different scale than the highs and lows on the same day. So running a regression of highs is not very different on this scale than running a regression on the price. So the closing price. So it will look on this chart just a line fit on the prices. Nothing like support and resistance.
Right. So, but I think that's kind of important because like we can't clearly, like just by connecting just the highs, we probably won't get the exact high for the next day. So there will be an element of error there. But
So what you have essentially taken as highs and the supports and resistance are essentially different definition of the trend line.
yes, so we could say that it is kind of it is
And
a trend line.
And if we do that over a large period of time of 20 days period, the resistance and the support will not be significantly statistically different. They will coincide statistically. Because over the period, the amount of variation you see, the daily variation is much less
I
compared
think
to
some sort of separation. No, I'm saying in kind of volatile stocks, we would have some sort of
How do you
thread
think
between.
you can identify support and resistance if you're looking for this kind of support and resistance?
I'm sorry, sir. Could you repeat that?
How do you think you can identify this kind of support and resistance? The picture is correct, but how you can you think of any algorithm of identifying this?
Sir, maybe if we don't take the like just the high points, if we kind of take a more representative data set, then we could.
Okay, fine. In your report, there is no mention of the team effort. Of course, your other team members are outside today. And also the code I just checked is also in your repository. So what you want us to put for team effort?
No, sir. Actually, the team work has been done by everybody itself. So we divided into two parts. The first part was the research element. So that was done by Revant and Rishi, and the code was
Okay.
done by all three.
Good.
But it was just hosted on my.
Good. Varun, do you have any question?
No more questions.
Okay. Thanks, Rahul. Thanks very much for your effort.
Thank you so much.
Just give me another 15 seconds.
Till then, you can start sharing a screen, Team 53, and we'll begin as soon as sir is ready.
Yeah, sure. Is it visible? Can you confirm?
Yeah, it's visible.
Thank you.
Yes, let's start this.
Okay, so good morning, everyone. We are Team 53 and we are going to present our final report today. Before starting, I would like to state a famous quote. Successful people do the simple thing, but differently. So this is the table of content which we are going to present today. We have three hypotheses which we are going to present. So let me start with the first hypothesis. So our first hypothesis is combination of mean reversion, one minute, please. Combination of mean reversion and engulfing or harami candlestick patterns is highly effective for large cap and liquid Indian equities. So the basic question is why we have chosen this hypothesis. We all know that mean reversion strategies generally provide highest accuracy as most of the time market is being sideways. But still, we need to identify the time at which we need to take a position in the market. To help us with it, we have used reversal predicting candlestick patterns like engulfing and harami to correctly timing the entry and exit in the market. So next question which comes in your mind might be how we have doing this or like how we have done this. So as you can see in the figure third A and third B, whenever the price is below the 200 days simple moving average, we are looking for the bullish opportunities. because we want mean reversion, and we go long if we find a bullish engulfing or bullish harami candle by placing our stop loss at low of the previous two candles and risk reward ratio as 1:3. Similarly, we search for short opportunities whenever the price is above 200 days SMA and go short when we find a bearish engulfing or harami candle while placing our stop loss at high of the previous two candles and a risk reward ratio of 1:3. Now coming to the back testing results we got. So we have basically back tested our results for four major large cap sectors in the Indian market, which are banking sector, auto sector, IT sector, and the metal sector. From the back testing graphs, as you can see in the performance metrics, it is quite clear that our strategy is giving somewhat good results than the benchmark performance results in all of these sectors. So what we can draw from this? So the above backtest basically confirms that there is a potential change in the market sentiment, which suggests that the previous trend may no longer be in effect. And we have used candlestick patterns and the mean reversion strategy to find when the market sentiment is changing and take profit out of that. So this is our first hypothesis. Now let's move on to our second hypothesis. So our second hypothesis states that doji candlestick formations within the Indian financial market, particularly in sectors that are susceptible to interest rate fluctuations, is indicative of a robust positive correlation with the accuracy of breakout predictions. Now, why this hypothesis? Once again, that question arises. People generally try to find market reversal with the doji pattern, but with our previous experience and the backtesting results, it is quite clear that it leads to more stop loss hitting than profit. So we decided to use doji for predicting indecisiveness instead of reversals. We know that whenever interest rate decreases or increases, the credit in the market increases and decreases respectively. And due to that, the sectors which are effective or like sensitive to that particular credit in the market get affected. And we are going to capitalize on that opportunity. So now big question is like, it might seems too much hypothetical, but like we are doing it. So big question is like how we are doing it. So we know that indecisiveness in the market increases when the market stretches towards its extreme. Hence, we use the standard deviation to find the stretches in the market and found the areas in which we can find opportunities. As you can see in this figure 9A and 9B, whenever the market price reaches within 30% of the 1.5 times the standard deviation plus the market current price, we search for the long positions. And whenever the doji appears, we know that there is indecisiveness. And if bias emerges on the following day, we take the long position by placing the stop loss at the low of the doji and taking risk reward ratio of 1:3 at that particular point. Similarly, we go short whenever the market is below the 70% of the 1.5 times the standard deviation plus market price, and doji appears, and we place our stop loss at the high of the doji and with a risk reward ratio of 1:3. Moving on to the back testing result this strategy gives. You can see we have back tested is on banking, auto, metal, and IT sector. So from this back testing, it is clear that it is giving somewhat better result in banking or auto sector as compared to metal and IT sector. And as you know, that credit and interest rate in the market plays a huge role in banking and auto sector because of their sensitivity to that particular sector. So we can easily conclude that the sector which are most susceptible or like sensitive to the interest rate fluctuations during the period are the ones which shows more indecisiveness and gives us more opportunity to place trades and gain profit. So thank you. Moving on to our second presenter.
Okay, so now let us talk about our final hypothesis, hypothesis 3. It states that a resistance breakout buying strategy characterized by the acquisition of securities subsequent to breach of resistance level in highly liquid and high momentum Indian equities holds the potential to generate substantial returns. So basically, we know that the Dow theory suggests that markets are made up of generally three phases: the accumulation zone, the markup zone, the distribution zone, and the markdown zone. So what we are trying to do, we are trying to create a simple strategy which the basic of trend following, which is the creation of higher high and higher lows. We know a resistance is a zone where sellers are present. If the buyers are able to overpower them, then that's a clear indication of stock entering into phase 2. That is a markup phase and a good probability of a trend getting emerged from the consolidation zone. So basically, the strategy is to buy when the previous swing high is broken, keeping the stop loss as previous swing low. And what we do, we just try to trade our stop losses. We kept no targets. So we try to get maximum juice out of the trend. So for example, in figure 15, you can see what we did. We bought here when this swing high was broken. Then we just trail our initial stop loss was here. Then we are just trailing our stop losses till the previous swing low is not broken. And on this top, when the previous swing low was broken, we just sit out in cash. So basically, if you see the backtested results, then in large cap banking sector, you can see the returns of 109%. The auto sector, you can see returns of 48%. Then in IT sector, you can see returns of 103%. Then metal sector, you can see returns of 323% over a period of 3 years. Now, actually, this results confirm that you can easily outperform the benchmark by just following the simple trend following basic thing that everyone says, which is the creation of higher highs and higher lows. Now, let us talk about some conclusion, what we did. Now, this is our results in a tabular format of hypothesis 1, hypothesis 2, and hypothesis 3. So basically, the best Sharpe ratio we got was in the hypothesis 2 of 2.18. In the hypothesis 1, we learned that the mean reversion and engulfing or Harami patterns may provide useful signals for entering trades and exiting trades. In the second hypothesis, we saw the correlation, the positive correlation between the interest rate and the doji candlestick patterns. And in the third hypothesis, we try to see the Dow theory and the application of higher highs and higher lows in the Indian equities. And we tried to capitalize on all of these points. Now let us talk about some future scope, which most can implement. For example, we can use machine learning algorithms like LSTM, then also parameter optimization we can do using ML. Then also Indian markets are highly susceptible to sentiment analysis. So we can even use the correlation with the sentiments and find out different, and we can create more hypotheses. Also, we can backtest more and more patterns. More and more patterns we can backtest. And also we can use our execution skills by using HFT trading methods. So these are some references and our member contributions. Thank you so much. Sir, we are open to questions now.
Okay. Varun, do you have any question?
Yeah, I just want to hear from the team about the hypothesis 2. Like, why did you pick interest rates, and why are you studying only the effect of interest rates with dosing? Like, what is the base idea behind that?
Our basic idea is that the sectors which are more sensitive to interest rate, like whenever the monetary policy changes or whenever the interest rate changes in the market, they generally show indecisiveness or they fluctuates, and the doji candlestick is basically used for indecisiveness predicting, and we just want to check whether we can find a
so basically, so you should also consider whether the doji is formed when the interest rate news is released, or maybe the change in interest rates was there, right?
Sir, we are finding doji, then we are taking the trades.
Sir, basically the point is generally the market is the market discounts everything, so we can't time the doji actually, because people actually before only know everything. So
yeah, that's exactly where I'm getting into. So doji can form because of anything, right? Inflation can happen because of many factors, not just the interest rates.
Yeah.
So why are you settling only the interest rates? Was my question. So why to find the relation, and why to justify the effectiveness of doji by connecting it to interest rates? So it just looks like a random thing. You're not considering that, okay, yesterday interest rates were changed, or today they were changed and there is a doji. Then there might be some effect, right? So maybe 3 months back there was an interest rate change and now there is a doji form. Like, how can you justify the relation? That's just my question.
Sir, to compensate for that particular thing, we have also used standard deviation. Like whenever market stretches, there is a chance that doji might form and we can get a trade.
So basically, it's like forgot interest rate also. You can just say market is at extreme and there is an dozy. Probably it looks like that study than comment on interest, but that's fine. So you compared with a couple of sectors. I guess 3 sectors you've taken.
Yes, sir. 4
And
sectors.
okay. So Pradip, do you have any questions?
Okay. So let's pick a random hypothesis. Hypothesis 2. Okay. You have 4 sectors.
Yes, sir.
Let's say banking sector or the banking sector.
Okay,
Yes, sir.
So before putting that graph,
yes, sir.
the report, the performance graph, how many backtests you ran for that?
So taking different parameters or like with the same parameters?
Taking different parameters.
So we have like back tested like for shorter durations also. So it is might be for shorter durations.
So how many backtests you have run to generate that curve? They generate that graph.
I think so. We have back tested it like 5 times something, 5-6 times.
5-6 times. Okay.
Yes, sir.
And what is your trading frequency? Is it quarterly or monthly or something?
Sir, it is 1 minute for this strategy.
1 minute.
Yes, sir.
And your slippage cost assumption?
Slippage cost?
Slippage cost, sir, it was 0.002 initially we kept it.
Okay. I have seen many backtests, more than what I should see. But it seems that there's something wrong with your backtest.
Like what?
Either it is discounting the cost too much, or there has been too many optimizations on the backtest. So I can't say which one.
Like, can you give us like a hint
Because
like where like
we just did the simple thing. We just plotted the standard deviation and the doji. That's it. Means what parameter optimization we can do actually.
we are like
there is no.
Means it looks like so from your description it looks like that. So can you give us one strategy that we can reproduce? So you have done 3 hypotheses, of which you have 3 sectors, 4 sectors each. So total 12,
yes,
right?
Sir. Yes, sir.
So can you share the strategy code with which we can reproduce that second hypothesis, second chart.
Okay, sir.
Okay,
we
sir.
are sharing the link for that code. Like, is it okay?
Sorry, or we should share
or we
the
could
screen
share
now.
in the screen, like if you want.
No. You can share it. I can have a look at it later. It doesn't have to be instantaneous. We don't have time for that actually.
Just a minute, sir. Can you share like one link?
No, just check with your coordinator, then he or she can share the link with us.
Okay, sir. We will share the whole repo with you actually.
No, not the whole repo is required. I might get confused which one to run. So this particular large cap auto, or rather this large cap banking sector in the hypothesis number 2.
Okay, sir.
Okay, sir.
So the code that I can just copy paste and run.
Okay, sir.
That's it.
Sure, sir.
Thank you.
Okay, thank you. So backtest links are actually here only. In the PDF, there's a backtest links also there. Means the results of our backtest are already linked to the PDF actually.
Yes, I see that.
So we should share the code, no? You want code actually?
Yes.
Okay, sir. We will share it. Sir, do let us know by the coordinator.
Sure.
Okay.
Thank you.
Thank you, sir.
I think shall we take a small break before we reconvene?
Okay, sure.
Okay, cool. Thanks, Ananda. Varun, let's come back in say 10 minutes or so. So right now it is 11:32. So let's come back at 11:45. Does that sound good?
Yes, Pradipta. Sounds good.
Cool. Thanks, guys.
Thank you, sir.
Thank you, sir. Thank you, sir.
Ananya, can you test your buzzer sound once?
Sure, I'll play it. One second.
It is audible.
Hi guys, can you start again?
Yeah, sure. Team 29, can you start presenting your screen?
Yeah, just give me 2 seconds.
Also, to inform you of the rules, there will be two buzzers. One will be at the 5-minute mark and one at the 8.5-minute mark. Abhi, are you ready?
Yes.
Okay. As you can start your presentation whenever.
Yeah. Hello. Good afternoon, everyone. Yeah. 1 second. 1 second. Good afternoon, everyone. So my name is Vivek Pandey, and my teammate Udayan Chatterjee and my teammate Monish Swami sir. We are all here to present. We are all here to present our hypotheses for the price action trading strategy. So we use a simple uh, price action trading strategy to implement buy or sell signal, to give buy or sell signal for our strategy. So here we have used two conditions, one for buy and another for sell. We have used OHLC data, OHLC 5-minute and 15-minute data in our hypotheses. In the Blue Shift platform, we only had option for 1 minute and 1 day historical data. So we implemented custom functions to extract 5-minute and 15-minute OHLC data. Now, the strategy that we have used here, the basic mechanism behind it is that uh, whenever the open price and close price lie within certain range, which we denote here as epsilon 2, then depending on the second condition, we can give a buy signal or a sell signal. Now we are going to give a buy signal if the low price of the candle is the difference between the low price of the candle and the minimum of the open and close price is less than epsilon 1. Now, what is epsilon 2 and epsilon 1 here? Epsilon 1, we tried different values for epsilon 1 and epsilon 2. First, we started off by 0.1 times the current close price of the candle. But with that, we couldn't get any good results. So we implemented 0.01 times the current close price. And similarly for epsilon 2, this is the most optimum value of these parameters that we could get. Now, how this strategy works is that whenever the low price, I'm explaining this for the buy condition, whenever the low price is lower than a certain value, this means that after a certain time interval, because the market is bearish, and after a certain time interval, the market is going to reverse its current uh, trend. That is why we are giving a buy signal, because when the condition first and two after in the condition for buy heading, when this occurs, the price is going to move up, and hence we are giving the buy signal. In the condition for sell, what we're doing is when the difference between the high price and the maximum of the open and close price is less than a certain value epsilon 1, this means that the market is currently bullish, and after a certain time interval, this trend is going to reverse, and the price of the underlying security is going to fall down. That is why we are selling it. Udayan, can you please change the slide? Yeah. So we have tested our hypotheses on the top 10 Bank Nifty stocks, which are listed here. And the period of testing is from 1st July 2017 to 1st July 2022. We have used the Bank Nifty index because these are the most traded apart from the Bank Nifty index, which is because we have not tested our hypotheses on futures, options and futures data. We have tested it on equity data. And for that, we have used the top 10 stocks in the Bank Nifty index. Can you please change the slide? Yeah. So the results that we have obtained here is that we have got a return of negative 10.85%. We got an alpha value of minus 0.06, a beta value of 0.42, a Sharpe ratio of negative 0.12, and a drawdown of minus 24.21%. Clearly, this is not the result that we optimally want. That is why we had to reject this hypothesis. Because of various problems with the Blue Shift platform, uh, uh, we couldn't test and optimize our hypotheses further in order to get better results, such as a positive return. Next slide, please. So yeah, this was the end of our hypotheses. Yeah, thank you.
Varun, questions from you?
No questions, Pradipta.
Okay. So how many times you tested to optimize the epsilon 1 and epsilon 2?
Uh, uh, we have completed our discussion. So any further
What is
Q&A?
the number of times you have tested to optimize the values of epsilon 1 and epsilon 2?
Yes. Yes.
Am I audible?
Yeah, you're audible.
Hello.
So team 29, have you got the question? How many times you have tested? How many back tests you have run?
Is my voice audible?
Yes.
You're audible. Can you hear us? I don't think you can hear us. Team 29, can anybody else inform Vivek?
Hello.
Yeah,
Is my
Vivek.
voice audible? Can anyone confirm?
So Anina, I think you need to tell them that there's some communication problem here.
Yeah. Udayan, can you hear us?
Yeah.
So can you
I
just
can
tell?
hear you.
Yeah, you
Yeah,
can hear.
I can hear you.
Yeah, okay.
Okay, so the question is that how many backtests you have run to optimize epsilon 1 and epsilon 2?
We ran 3 backtests in order to get the most optimal value of these parameters.
Okay. Thank you. I think that's it. So we can move to the next team, but we'll require some time before that.
Yeah, sure. Thank you.
Thank you.
Yes, let's move on to the next.
Okay, sure. So the next team is team 17. So are you ready, team 17?
Yeah, hi Ananya. Can you just get maybe 2 minutes because we thought that the meeting will be ending by we'll be starting by 12. So just 2 minutes.
Yeah, you can set up your screen.
Yeah, thanks a lot.
We are waiting for something or someone.
Yeah, they were just setting it up, so you guys can start, I think, and there'll be two buzzers, one at the 5-minute mark and one at the 8.5-minute mark. So please begin.
Yeah, cool. So hi everyone, we are team 17 and I'm Aditya Agrawal. So so this is our PPT for the project price action trading strategies, and we formulated a hypothesis and backtested it. So let's move on. So this is our table of contents. We'll first be introducing what is price action, then the hypothesis formulation process and working hypothesis, and so on. So introduction. Hi. A price action strategy basically involves focusing on price movement and behavior over time rather than technical indicators, maybe, or to predict upcoming trend or movement and take up relevant short or long positions. So yeah, so our study led us to examine various technical tools to implement our price action trading strategies, such as chart patterns, support and resistance candlestick, and so on. So hypothesis formulation. In our hypothesis formulation process, we classified market into different regimes, mainly based on like we tried using SMA, but SMAs in the technical indicators were mostly lagging. So we identified bullish regime by seeing whether past 15 days and 30 days highs are the same. It means that if the recent high was made 15 days ago. Also, while formulating our hypothesis, we also identified local extrema points, maxima and minima points, and quantified various chart patterns like head and shoulders, ascending triangle, double top on the basis of relative position and distance of extremas. We also tested various bullish and bearish candlestick patterns. So next, this is our working hypothesis that we finally decided to move on with. So basically, our null hypothesis is that bullish candlestick reversal patterns work better on a 1-day time frame compared to 1-minute time frame. And this is our alternate hypothesis. So basically, the idea behind this was that in lower time frames, our frequency of trades, like our frequency of occurrence of bullish candlestick reversal patterns, will be very high because noise is high. But while in higher time frames, both will be low. But we need so we aim to find a suitable time frame to maximize our frequency of trades and minimize the noise, because we don't want a lot of noise, and we want proper signals, yeah. So next. Mayank. Okay, I think.
I'm sorry. I just when it came to stock universe selection, we initially were, because we had attended the intro talk, and you guys had quite aptly mentioned that we don't want individual stocks or certain kind of biases to creep into our hypothesis, and you wanted a very suitable sample size of the Indian equity market. So initially we were going for Nifty 50, but since the hypothesis that we wanted to test involved studying the candlestick patterns that appear in a bullish regime, we decided that we'll go forward with a certain test. And also another point, that why did we decide to use Nifty 50 stocks? The simple reason that them being a representation of the market, them having really high liquidity, that ensures that most of our orders would be executed on price, and we can assume negligible slippage. Then came the point that is there some problem with this? Okay, I'll just continue. Also, yeah, when we were trying to classify the stocks, we do not want to backtest individual stocks and then select them into our final stock universe, because that would also kind of created a certain prejudice. So we initially classified them into their respective sectors. You can see our report also. We have basically explained it in quite detail in the report. So we had different sectors. And on those sectors, from 2017 to 2018, we ran backtests. Our backtests were not traditional technical indicators. We ran tests like we checked the number of positive candlesticks that appeared versus the negative candlesticks. We checked for drawdowns, the percentage of drawdown that was appearing in those stocks in that year. And then we came up with the final subset of those stocks. And we assumed that these stocks would have a more or less continuation trend in the backtesting period that was from 18 to 21. And that's how we selected our stocks. Next slide, please. So yeah, now for our strategy implementation, we had decided to go for two separate simulations for our hypothesis. One which would incorporate the 1 minute frequency, and the other that would be executed daily on a one day candlestick pattern. Artisan period was from 18 to 21. We had identified the certain candlestick patterns that we mentioned below that we were going to look for in these data, and the entry and exit logic and stop loss that we also explained below, we had them incorporated in the basic different functions that we had defined on the code. And hence also a point on the strategy that we used for weight assisting. Initial backtest that we were running, because our number of stocks in our basket was quite large, so and we had assigned weights to the trades that we were executing, but the movement of our portfolio was quite less because the weights were quite less. So we decided to incorporate certain leverage. We defined our I think it was 20, right? It was 20 times the leverage for every stock that we were having, multiplied it to the weight, and then we were executing the stocks, and then we got the results up to our mark. The next slide. So entry, exit logic, stop loss, and risk assessment, right? We ran initially when we were trying to put a certain percentage. That was basically when we saw the implementation in the examples given on the website and on even on the say example strategy that were present on your websites. We were seeing that there were certain predefined profit loss and profit booking and stop loss values that were like 1%, 2% was a stop loss of 1%. But we realized we mentioned it in detail in the doc that we found that the results are not consistent for 1 minute and 1 day frequency. So we decided to backtest our stock data and calculate average candles size percentage for every stock that we were testing, and we found it to be 1.28 for daily candles and 0.1 for 5-minute candles. We had 5-minute candle data. We didn't have a 1-minute candle data, so we ran it for 5-minute on our local PCs, and we set our profit booking stop loss such that they would have a more or less slightly similar ratio for both the tests, and we'd have a more accurate representation of our tests. The next slide.
Coming on to assumptions, our first assumption is that slippage will be negligible. Since we have taken Nifty 50 stocks as our universe, these stocks are highly liquid. Therefore, slippage will be negligible. Our second assumption is that transaction cost is 0. Now, the main reason for this assumption is that because we want to compare the performance of candlestick during 2 different time frames, and we want to show that this difference in performance is not only to transaction cost, but because of the difference in reliability and performance of different candlestick patterns in different time frames. Our third assumption is that we are buying and selling at closing price. However, in different in live markets, our buying and selling price can be different from closing price. Our fourth assumption is that in long term, momentum will continue. Coming on to candlestick patterns, we selected 5 candlestick patterns, and all these candlestick patterns are bullish reversal signals. Now, the reason that we have selected these 5 patterns in particular is because the frequency of formation of these patterns is high, giving us opportunities to trade in live market.
So
Mansi, your mic is mute.
I'm sorry. We found out the results by running the backtest, and we found out that the Sharpe ratio in a 1 minute time frame was in negatives, while in a 1 day time frame it was in positives. And this Sharpe ratio is a huge, very important metric in measuring the performance, as it tells us the risk adjusted returns. And of course, following our hypothesis, the annual returns was also negative in the 1 minute time frame and was positive in the 1 day time frame. Omega ratio is another parameter which is used when we have huge frequency of trades, and it is a very nice parameter for analyzing the results. And we found out again that in the 1 minute time frame it was higher. A Sortino ratio is another variation of Sharpe ratio, you can say, and it basically penalizes harmful volatility, and so it takes that into account. And again, it being higher is a greater indicator, is an indicator of a better performance. And we found out the Sortino ratio was also higher in a 1 day time interval as compared to when we ran it on the 1 minute time interval. The stability of time series was also more in the 1 day time interval. And this indicates that we can reject the alternate hypothesis. So these were our results.
Moving on to the alternate hypothesis, first of all, we landed on a hypothesis that bullish candlestick patterns
Excuse me.
work well in trend
Time up.
work well for trend continuation.
Excuse me.
Identified this.
Pause, Aditya, they're saying something.
Time up.
Okay, guys, this is a very interesting project. So, Varun, do you have any questions here?
Yeah, just want to know why the team selected the particular candlestick pattern. Did you guys try the other patterns also and then decide?
Yeah, we actually when we were looking for resources online, because we hadn't implemented candlestick patterns before, so we were studying them and we found out like there are around 40 odd patterns that existed, whether for reversal or continuation, and they were even classified on bullish and bearish, right? So we did test a few of them, and these were the ones that were providing consistent trades. That we also, when we checked our logs, we were seeing that it was trial and error mostly, and we finally came down on those 5-6 that we showed you on screen, and those were the ones that we.
So can we generalize the result to all candlestick patterns, like in short term or probably in 1 minute, the result or returns or probably the signals are not as important as that are generated on higher time frame, right? So can we generalize like that?
Yeah, so we haven't backtested on the other candlestick patterns. We just backtested on this 5. So based on our backtest results, we can't generalize it for every candlestick pattern, but I think we can test for other candlestick.
That's the whole idea behind this hypothesis was upon the data and the noise that kind of it was when we were finalizing our hypothesis, we did think that maybe there is there has to exist some sort of correlation between as the noise decreases and the amount of data that we can extract from a particular candlestick. And it was more or less, yeah, it was restrained on the time of how many candlesticks and how scalable the hypothesis would be on a general candlestick pattern versus the ones that we tested on, let's say.
So given the time, do we how would you change your hypothesis to probably include noise as well, define some metric for noise and understand how noise would impact the predictability of a pattern?
More false positives will be generated, and as the more amount of candlesticks we have in a particular time frame, say 1 minute or even I would say 5 minutes, the more number of the market would be more volatile. We would not be able to correctly estimate if a certain pattern that emerges would result in the kind of position that we're trying to take or would be a false positive. That was our point in noise being the factor.
So good work. So Pratita, you can ask your questions.
Okay. So you have some differences in the way you have implemented the daily versus the minute strategies, right? Your metrics are different. Your parameters are different.
Are you talking about the profit booking and stop loss?
And also the candle size.
Yeah, about the whole thing. Yeah, and we were initially testing now. So we decided, like we saw we had two functions, right? Predefined functions of set profit loss and set stop loss. And that was like, we can put it on 1% or 2% and something like that. But even when looking at the trends and looking at the pattern, I mean, the graphs, you are seeing that, first of all, the candlestick size is going to be mattering, right? Because a certain stock moves say some fraction in a minute, And based on those accumulation of say 60 such minutes, we form the 1 hour candlestick, right? And based on such 6 hours, we form the end of the day candlestick. So I'm not saying it will all be moving in a similar direction, but it will have a certain impact on the final candlestick shape and the size, right? And it was not something that you'll find anywhere else because we formulated it. It was also a conjecture that key candlestick size should be a factor in booking the profit rather than
the candlestick size is, of course, it will vary because the move that happens in a minute is much less than the move that happens in a day.
Yeah.
What would have been a more statistically correct way of scaling this?
Statistically more accurate of scaling it. I can't seem to follow your question.
So
I mean,
what you
if
have
you're
done is that you have checked the average size.
Yeah, we have checked average size for those candlesticks
And
over a
then you
6-year
have,
frame.
and then you have taken a ratio of that.
Yeah, we have pulled that ratio to have a certain threshold. We also, yeah, I get your point. We also tried to incorporate this candle size value as we could have taken not just the back-tested data, like the 6-year data. We could have used the candle size as a parameter for booking profit or exiting a particular place. Like we could have had like closing price plus 2 times the candle size, like the cumulative candle size up until that has appeared.
Are you aware of the thing called volatility?
Yeah, volatility.
Do you think that scaling by volatility would have been better or worse?
I mean, now that you say it, it appears so. Yeah, I mean, we were apprehensive of using any technical indicators at first, but yeah, we could have incorporated volatility. That's
okay. And you have one hypothesis for daily and the alternate is for minute. So essentially, you are saying that the returns generated from my strategy under null hypothesis is different than the alternate. Right?
No, we had a single null hypothesis, and the alternate hypothesis, that is like if we reject the null, so we accept the alternate. That is what we meant.
Yeah. So your null hypothesis is your minute, your daily performs better than minute.
Yeah.
And your
We could,
alternative is that it's not the case.
it's not directly correlated. Yeah.
Yes. So what would have been a statistically correct test to prove that?
I think, yeah.
Have you heard of Kolmogorov-Smirnov test?
What test, sir? I don't think I've heard of it, but what did you say? I would like to know, yeah.
Kolmogorov-Smirnov. So this is a statistical test that finds out if there is any statistical significance between two probability distribution.
No, we were not aware of that.
Okay, I think it's a very good effort. So thanks. So we can move on to the next one, but we'll require some few minutes before that.
All right. So, thank you, sir.
Thank you.
Team 17, you can stop your screen sharing. Team 13, you can set up your screen sharing till that. So there'll be two buzzers which will be played. One will be at the 5-minute mark and one will be at the 8.5-minute mark. Ananya, are you ready with the buzzers?
Yeah.
Okay, great. We'll begin as soon as the QuantInsti team is ready.
Hi, so we'll get started.
Just a second, till Pradipta sir will give you a go ahead, then you can
I
start.
see. Okay, sounds good.
Yes, let's start.
Hi everyone, we're team 13 and we're going to talk about a solution to the problem statement, which is the efficacy of price action trading strategies in the context of Indian equity market. And so we're going to basically talk about In this presentation, we're going to talk about all of these things, which are what our hypothesis is, how we chose the universe, and how did we basically get to this hypothesis, because I think that's a very important part of our thing. Working towards the actual hypothesis, and then we're going to talk about a couple of strategies that we ran, and that's basically what we're going to do. So our hypothesis is that 52-week high and lows are the most effective resistances and supports respectively across stocks in the Nifty 100, and breakouts when they occur do lead to extended momentum rallies. Right. So moving on to the stock universe. So to ensure the overfitting, we created multiple stock universes. So the approach we used for the same is as follows. So while selecting these universes, we had a world which is made up of 14 sectors of Nifty 100, and in each sector we tried to run some correlation tests. Now this correlation test wasn't over the daily data, but it was on the daily percentage change data, because that will tell you how correlated the daily movements are. And in the strategy which we run, it is the daily movement which counts, because every day there's going to be some sort of rebalancing. So a few of the results we found out is that the intra-sector stocks correlation is greater than 75%, which means that we can generalize it with the fact that stocks within the same sector have a somewhat similar movement. Coming to the next result, that the inter-sector stocks have an average correlation of 28.7%, and few of the insights we gathered is that PSU stocks are highly anti-correlated to most of the Nifty 100 stocks. So moving on to the buckets we had made to test all these strategies. So these are the following stock universes we made. So firstly, we had made stocks which had all types of movements, starting from low correlation to high correlation. Then we chose a universe which only comprises of the two indices, which is Nifty and Bank Nifty. So that, there is also coverage of the type of stocks which have low volatility and low movement. We run this strategy on stocks which are highly anti-correlated. So for example, there were many stocks, despite being a part of the same Nifty, which are moving in opposite directions. And to make sure that these stocks are also incorporated using the same strategy, we made these buckets as well. Beyond this, we run a correlation of daily prices to make sure that the long-term movement is similar, and then we try to see if these can still perform well. So the period of consideration was 3 years before the 2018 period, so that there's no look-ahead bias. And we created the following subcategories. One is stocks that have overperformed with respect to Nifty 100, stocks which have underperformed with respect to Nifty 100, and a stock which has had a lateral movement across the horizon. We also created a universe wherein there are equal number of stocks in all three categories, which is 3 each. Moving on. So the road to hypothesis includes we tried out two strategies, mainly two types of strategies. One is momentum-based strategies and mean reverting strategies. In momentum-based strategies, we tried the MACD, which is the moving average convergent divergence, the moving average crossover, and the ADX, which is the average direction movement index. In mean reverting strategies, we tried a candlestick pattern named hammer and RSI and Bollinger Bands. Momentum and mean reverting strategies could not provide any conclusive evidence, which is when we move to volatility-based strategies. But they could also not provide any conclusive evidence on their effectiveness on Indian markets.
So let's move on to support and resistances. So before we go into the details of why support and resistances, I'd like to take a couple of minutes to talk about how we identify and draw these support and resistance lines. So first, we use something called a Savitsky-Golay filter, which is used to smoothen the price and eliminate noise. So once we are done with that, we then identify the extrema, that is the local minimum and local maximum. Once we have the indices of all the extrema, we then basically run a linear regression to fit a line which passes through most, or which gives the best fit across the minimas or the maximas. But before doing that, we exponentially give more weightage to the recent points, so that the algorithm, so that the lines which are drawn by the algorithm are much more closer to what a human would draw on the trading screen. So given that we know how we draw, given that we know how we identify our support and resistance lines, let us talk about why we chose to do that. So the primary reason why supports and resistances tend to be self-fulfilling is because of the herd instincts of market participants. So the more times a support and resistance is tested, the more the participants believe that they are actually very strong and they will hold in the future too. But is that really the case? Let's look into it. So we propose that the more times the support and resistances are tested, the likelier it is to fail. The reason for it is that at high frequencies, most of the orders which are placed around support and resistances lines are due to limit orders, which are by market participants expecting a reversal in trend. This is because once we extrapolate the support and resistance lines, we know where the price is going to intersect with, we can use limit orders more effectively, and that is why most of the orders near the support and resistances tend to be limit orders. But when the support and resistance is tested multiple times at higher frequencies, these limit orders tend to get exhausted, and that is when a breakout will most likely occur. So this is why high volatility and sentiment-driven stocks don't really follow trend reversal for an extended time period. So given that we know this, let us move on to our main hypothesis. Let's see how this connects to our main hypothesis. So as support and resistances tend to be more effective with how pervasive the information is in the market participants, it is only natural to expect that the 52-week high and low is a very strong support and resistance line, because the 52-week high and low information is one of the most publicly available, and you can get it very easily on any website or newspaper you look into. So that is why we hypothesize that the 52-week support and resistance will be strong, and there will be a tendency to revert. But given that a breakout occurs and it holds, it will lead to an extended momentum rally. So let us see how we test this strategy to see if our hypothesis is
right. So now I'm going to talk about the actual implementation of the strategy. So essentially, in order to figure out the 52-week high and low, you have to sort of have a variable which stores the high and low data. And then after which, now in order to test the breakouts, which is the number of days the closing price is outside of this high and low band, you essentially have to, that's a hyperparameter we have to keep in mind, which is the number of days to declare a breakout. And the greater numbers of days, you've confirmed that this movement in price is significant because it's outside this band. But the more days you wait for this confirmation, you're potentially making less money because you're obviously using all of that information to now confirm instead of make trades on. So you store the price, you wait for this breach to happen on the basis of what we're calling a breakout, and then you keep that position. And you keep that position up until the point where we have this, what is called percentage trailing stop loss, which I'll talk about in a little bit. So this percentage trading stop loss is in this exit position, and it essentially from the maximum, it's essentially a drawdown percentage. And this drawdown percentage of 5% will basically tell you when you should exit the trade. So that's also ties into our risk management, which is basically, since 52-week breakouts are relatively rare and lead to large moves, instead of keeping a fixed loss, we sort of keep this drawdown type of metric, which will basically allow us to get profits without preventing heavy drawdowns because it's capped at 5%. And in order to talk about some of the other important parameters, we have trading commission and slippage. And since we're trading Nifty stocks that are very liquid, we keep 0.3%, which is a very conservative form of slippage. Okay, and finally, in terms of the portfolio management and asset allocation, we essentially choose to keep it equiveighted because we don't have any particular reason as to why one breakout would be more significant than the other. So finally, coming up to results, we backtested on 2018 to 2021, and we had an average win rate of 36%, which is under 50%, but you can see that average winning trade percentage, the gain, is significantly higher than our average losing trade. And we can basically infer that for less liquid stocks, the 52-week breakout leads to longer momentum period, which makes sense. And we chose 6 sectors at random to make sure our model was robust. These sectors include FMCG, IT, and the likes. And finally, just to conclude, as we're short of time, we conclude that when the 52-week level breaks out, this is obviously a significant thing because it's in 52 weeks, and we expect it to, there's going to be an extended period of momentum after that is what our final conclusion is. And this information we can essentially leverage to produce a profitable trading strategy in the Indian markets. And we ran short of time, which is why I had to hurry it, but that's about it.
Thanks, guys. It's a very good effort. Just to remind, the project was not about finding strategies that makes money. It was about testing hypotheses. So your hypothesis is quite clear that you insist that the 52-week high and lows are the best support and resistance indicator. So what will be the correct way to test this hypothesis?
Right. So for this, we had as we mentioned with a service and they could not provide any consistent results. So when we tried to stop the same,
Sorry, guys, I can't hear you properly. Is it only me or?
Is it better now?
Yes.
Yeah. So when we tried out the like support and resistance lines using the Selfie Gole filter, we could not provide consistent results. But when we use the same stock universes and tested on the 52-week high and low, we got a much lower drawdown because of a trailing stop loss. Also, the winning rate, as you can see, is much greater. So when we talk about support and resistances, we try to identify that these were the most reliable and robust support and resistance levels.
Right. If you want to analyze how good, how true this is, one thing which I think we've done, we failed to mention is we can see how long this breakout lasts. And we can analyze for each stock how long this breakout lasts, and then we can take an average over all of the stocks in consideration and divide them into different wins based on volume or the market cap.
No, so you guys are insisting that 52 weeks high and lows are the best resistance and support measures. So the way to test it will be to come up with an alternative measure and compare the results. Right?
Right.
So I don't see that.
So basically, when we talked about supports and resistance in a general sense, we found out we found out like the efficacy of the strength of these supports and resistances as a parameter, which is the number of times they have been tested. So we found out that at 2 or 3 when they were tested 2 or 3 at a minute frequency, they were decently performing, but by the time they were 5 or 6, there were no profits at all. So compared to the 52-week strategy, which is consistent, supports and resistance at a lower frequency are not really consistent, and that is why we believe, and I think our data shows that 52-week supports and resistance are much more impactful than supports and resistance during any other time.
But the comparison should be running the same strategy, just changing the definition of support and resistance, isn't it? That makes sense, right, guys?
I think the net connection is a bit off.
Yes, I see them frozen on the screen.
Am I audible?
Yeah, you're audible.
Hello?
Yes, you are.
Am I audible?
Yes, you are. So the question was that in the proper way to test it, I think they can't hear us.
Okay, there was some connection issue on this end, right? So the other team dropped off. So to add on to what they were saying, like I'm not being able to hear you, but like I'll just add on to what point was made earlier. So to support our hypothesis, right, as Shreya said, we maintained the same universes of stocks, and we tried 2 different implementations of supports and resistances. One is the 52-week strategy, and the other was another implementation using trend line. So basically, we stated it right. We found the minima points, maxima points using some method, and then we tried to find the best fit light and used it as support and resistance, and that gave a much lower gains and higher drawdowns compared to our 52-week strategy. So that bolstered our hypothesis.
I think we can move to the next one. Just give me some time.
Yeah. Team 41, can you set up your screen sharing? Team 41 are you guys there?
Yeah, just give us a second. Yeah.
Yeah, sure. So there'll be two buzzers that will be played, one at the 5-minute mark and one at the 8.5-minute mark. And you can begin once Pradipta sir gives you a go ahead.
Yes, let's start.
Okay. Good afternoon. We are Team 41, and I am Sean. And I will start by explaining our hypothesis. Sorry, am I audible? Okay. Our hypothesis states the market's tendency to retrace and fill inefficiencies provides a potential opportunity for profitable trades in liquid stocks. Our hypothesis posits that when market inefficiencies arise, prices have a tendency to move towards correcting these inefficiencies. So our hypothesis states that markets can be inefficient for a short period, but will eventually tend back to efficient period. So what is an inefficiency? By inefficiency, we are referring essentially to order imbalance, which refers to a circumstance in which there is an unequal distribution of buy and sell orders for a specific asset, resulting in a mismatch between the asset's demand and supply. You can see in the illustration the inefficient zone where there isn't much volume traded. We see a start of a big move. Our hypothesis posits that the price will retrace back to this zone. We move to universe selection. For universe selection, we use some basic broad criteria. We see that volatility in the stock price can create inefficiencies by causing rapid price movements that are not sustained. So we used higher vol stocks with a daily return standard deviation of greater than 5%. We have also used liquid stocks, but not highly liquid stocks, because one, the complexities associated with illiquidity and lesser inefficiencies in high liquidity stocks. We have also ignored penny stocks. Now we move to methodology.
So hi, I am Himanshu Kumar. And now that we have a clear goal to exploit the inefficiency, and Shaunak have formally introduced you to the concept, you can see an inefficient zone and will price retrace back to this zone is the question. So let's go for the first detecting this inefficient zone via price action approach. So to detect the inefficient zone, we have divided the process into two key components. First is identification of an imbalanced candle, and second is the marking of the zones around them. So the immediate high candle marks the lower band of the zone, and the lowest low of the preceding 30 candles mark the upper band of the zone. So with this, we move to the next section where our goal is to exploit the 1-minute trades. So it is necessary to address the issue, the noise on the issue. So to overcome this, we have implemented a novel approach of transition from the price time domain to the volume domain. So the concept of volume domain is simple. We club the price action with equi-volume bins. So you can see in the picture, the volume is constant. We have divided the price equally according to the volume bins. So this ensures that the candles are clubbed until a volume threshold is reached. So the basis of this approach is quite simple, that reversals are volume driven, but retracements are not. So the noise or the price action will be clubbed together. So moving further to the next slide, we present how the price time domain and the volume domain differs. So you can see there is a comparison between the price time domain and the price volume domain. The two charts are equal in time, but you can see the noise, how the noise is reduced, and we can see a clear price action in the volume domain. So the main challenges we faced into this were actually selecting the bin size. Okay, so we know volume changes gradually over time in larger time frame. So to account for this challenge, we used rolling mean for over a larger period. So this will smoothen out. And the second challenge was removing the outlier in the lower time frame. Actually, when the volume spurts in 1-minute time frame, we have to account for that. For that, we deployed the rolling quantile over the rolling mean we took over the larger time frame. So the pros is the noise reduction, and we can see a clear trend direction in this volume frame. But the cons is we have to go into the volume domain, so it is little bit we need computational resources. And second is the loss of information in the time domain. But we can anyway integrate both to create a strategy. With this overview of our price action analysis, we will move to the next session where we will dive into the quantitative analysis. Yeah.
So hello everyone, I am Rohit and I will be covering the quantitative analysis part of our presentation. Yeah. So before this, so let's first of all understand what exactly we are. So so first of all, let me explain you what exactly the retracement are. So as Himanshu already explained the upper and the lower zone. So in our case, we take the retracement as the simply average of this zone. So I have also mentioned the figure to help you illustrate the market covers the inefficient zone. And now to analyze this, I have just give us a yeah. So to analyze this, we have performed our retracement analysis of our 62 stock from our filter stock pool, and the result shows that 2/3 of the market retracement happened within a 5 candle, and then 95% of the time it closes within 460 candle. So now let's discuss about the trading strategy that we have created based on the retracement analysis. So basically, we have developed a simple trading strategy. We just take entry at the open price of a candle next to the verify candle, and we set our target as the upper level of the zone when the high of a candle closes the upper level, right? And we have also introduced a stop loss as a 3.6 times the standard deviation of the rolling 15 candle close. And apart from this, we have also considered a trend line breakout to take position, but the number of trades decreases significantly as the 2/3 of the retracement happened within a 5 to 6 candle. Now let's move on to conclusion and the result part.
Hi, I am Samarth, and let's move on to results and conclusion. So these are the results of the strategy backtest. So as you can see that the strategy did perform well. And for this particular backtest, it has annual return of around 30% and Sharpe ratio greater than 1, which is good. And one thing you might notice is that for this particular backtest, the drawdown was a bit more. So what we found that drawdown and profitability also depend on the stop loss. So for stop loss selection, as Rohit mentioned, we were using a standard deviation window size. So what we found that varying the window size, we were able to tune it for different stocks, and the strategy became profitable for all the stocks. So moving on to conclusions. So as we can see that the strategy gave consistent returns on different stocks, and also for stocks where the strategy didn't perform well, we found that we can tune the stop loss rolling window, and we can essentially scale it to across multiple stocks using a dynamic window size, and we were able to get a consistent returns and profitability of around 80%, 70 to 80%. And also from the analysis that Rohit has presented, we can say that the hypothesis holds true. And now moving on to contributions, like next slide. Yeah. So thank you. And these are the team members and their contributions. Thank you. You have any question, you can ask. We have done our presentation.
Thanks, guys. So this is a very interesting hypothesis, but it seems that your testing has some issues. So can you identify what can be the possible issues? Forget about coming up with a strategy that makes money. It's about how we test the hypothesis that you have stated.
Yeah, so for actually, since presenting for the result, we wanted to present the blue chip results, but blue chip was not working well. So a more robust back testing we did on our own on Python, and we did it across a multiple stock in the chosen universe. And yeah, so what we were looking out from the strategy was, will the price eventually retrace to the inefficient?
Let me stop you there. So suppose you can test whatever you want. Forget about how much you know about Python or coding or what data you have, right? Assuming that you can test whatever you want, what you wanted to test, what you should have wanted to test to prove or reject this.
we wanted to test that will the price retrace to the inefficiency zone, and is it
So
possible
what
to
should have been the strategy for that?
Yeah, so we implemented a simple strategy that as soon as the inefficiency zone is detected, and we have not yet reached the inefficiency zone, we simply go long and exit when the inefficiency zone is reached. And for we also chose a stop loss because if we don't choose a stop loss, we know that eventually the price will be retraced, maybe because of our hypothesis, or in few particular cases, maybe for other reasons. But we use a particular stop loss so that we don't miss out on the opportunity cost of having different rates, having different imbalances candles in the future.
Adding on to Samarth, what would I like to explain is one more possibility could have been like if price retraces back to the zone, we can state that price will continue along the direction which it was previously moving after reaching
No,
the
that
zone.
is not part of your hypothesis.
Right,
Your
that is
hypothesis
not.
is about retracement only.
Right, yeah.
Yeah, go on.
One thing I wanted to add was, I mean, what we could have done potentially, if we could short sell, is try to get both legs of the trade, but because we were trading stocks, we only tried to get that one leg on the way up because you could only buy.
So when you are testing a hypothesis by creating a trading strategy, right? You must have a strategy corresponding to your alternate hypothesis, so that you can say that these are the statistics from my H0, these are the statistics from H1, and based on this, I accept or reject H0. Or you should create a portfolio where you have zero cash investment. That is, it's a long short portfolio so that there is no out-of-pocket cash to be invested. Then only you can accept or reject a null hypothesis. In your case, it is not tested against the H1 strategy. That is number one. Number two is that introducing a stop loss for testing this hypothesis entirely changes the distribution, right?
Yeah, so but we wanted to account for the crashes and all. We knew the market will
crash is
retrace.
not part of your hypothesis, right?
Right, but to
so your objective is not to make money. Your objective is to test the hypothesis.
Yeah, so since our hypothesis, the analysis that Rohit presented, most of the retracement happened within 5 candles, and since we are taking trade in the second candle from the inefficiency, so and we are using standard deviation as a proxy for price change per candle. That's why we put the stop loss around 3 times. So so we can capture the target within the next 5 candles, and also we don't lose out on the opportunities of further trades.
Also,
And
to
adding-
add on to this, so basically we have divided our whole hypothesis as a 2 parts. One is whether the retracement happened or not, and second is whether we generated return out of it or not, right? So as a retracement part, as we already saw, 95% of the time the market actually retraces back, like from when there is imbalance zone actually. When there is actually imbalance zone, and to test the hypothesis on the basis of profitability, we are taking our position, like as we already mentioned, like buy and sell. Yeah.
So adding one more thing, if we do not implement the stop loss, the price will eventually retrace back. That is 99.8% of the time it is coming back. But for the statistical significance, that the inefficiency can be like the price may be some random function of random time, like it may come after 1 year, but that is not statistically significant. So for to account for that, we have used time window, like within 4 days to implement in our strategy. Time stop loss actually.
Okay, sounds good. Thanks, guys. I think Varun, do you have any question?
No question, just a small doubt. So is it a long only strategy, or are you considering both cases?
No, so for since problem statement mentioned that we can only go long. So for this strategy, we have only we are only going long, and yeah, we are only going long.
And one more thing, we could have gone short, but it is allowed only on the index futures, and they are quite liquid. But our hypothesis is about moderately liquid stocks, so we are only going long. But it can be tested out for the short also. Yeah, it was performing good actually on short side.
Okay, so was there any choice you had for like while defining your inefficiency candle? I mean, are there any multiple methods you guys thought of and finally decided the one you used?
So actually, for inefficiency, we were looking to capture the a large price movement in a short period of time, right? And also that the price levels are actually not traded for the past few candles, like 30 for our case. So that's why we actually created a threshold of body, which is like greater than the previous 30, like 32, some window size average. And we created zones of price which are not traded. So yeah.
Okay. It sounds good. Good work. So
yeah,
no more questions from my side.
Thanks, guys. Varun, can you move on to the next one?
Yes, yes. Okay.
Let's start the next one.
Yeah, thank you, sir. Yeah.
Team 21, can you start your screen sharing, please?
Just give me a minute.
Start with present screen. Who will go?
So your screen is visible. You'll be given 2 buzzers, one at the 5-minute mark and one at the 8.5-minute mark. You can begin your presentation.
Okay. Hello everyone. This is Team 21. So yeah. So the problem statement was the price action trading strategy. So price action is mainly revolves about the support and resistance. We try to do the power in the same way. So here are the few assumptions that we had earlier. These are based on our previous experience of the trading and previous experience of creating some quant models. So the assumptions as I mentioned here, the reliability of support and resistance level is the questionable with the average strike on that level. So the number of times it gets tested, it gets weaker and weaker. Second, then the using some more technical indicators like the ATR and
We can't hear you, Team 21.
Hello.
Yeah, now you're audible.
Did you hear anything before that?
Yeah, I think from the last 10 seconds you were not audible.
Okay, so I was saying that yeah, it's only about the resistance and use some other technical indicators, not exactly technical indicators, but the indicators that can show us the volatility and the momentum and few other parameters like volume if needed. Then we can create a strategy that revolves around the breakouts and the breakdowns. And third parameter is the noise in the market. So our assumption is in the first 15 minutes of market, because of the gap ups and the gap down scenarios, there will be more noise and we should not be trading in that. These are our basic assumptions. So here is my next slide, the hypothesis. So we can define the resistance and support levels for the stocks and the derivatives, the futures for allowed based on the previous price action. And we are going to use the average true range, the technical indicator average true range, and the relative strength index RSI for the validation of this level, and also determine some conditions for our trading. So the average true range, as per hypothesis, it should be act as the threshold for the identifying the valid price movements for the validating the recent lows and the recent highs. And RSI will be used to check the momentum in the market. Then to avoid the sideways market, we are going with the two things. First is if you are trading with the derivatives, then there would be a specific range of put call ratio. And in the stocks, we are going with the RSI values in the cash market stocks. And here we are using ATR to eliminate the small price movements and avoid false breakout. So the stocks that will be in our radar will be, as I said, we are going to use the for the futures. So if put call ratio is around 1, it does not give so much significance from the derivative market and it start moving very like away from the 1. So to avoid these particular movements, what we are going to do, we are just taking the put call ratio, just taking the trades. If put call ratio is less than 0.8 or greater than 1.2. Second, in the cash market, if RSI is more than 55. So like if RSI is more than 50, generally it's bullish, but as 55 is also a Fibonacci number and many other strategies use the 55 number as more generic number. So I've gone with that. So if RSI is more than 55, then only that stock will be covered. It should be an NSE 500 because we need the liquidity, and these also restrict us to like mostly trade in the buy side of the cash market because if RSI is 55, the stock is more of the time in the bull run. So in typical sideways market, like in recent days and last week, you can see you can't find more than 20 stocks in NSE 500 in the more than RSI. So this should be like expected number of stock in typical sideways market is 20. But if it is a bull market, you can expect 40 to 50 stocks. And for the index, for the futures and derivatives perspective, we will select the top 10 futures who have like most high volatility based on the put call ratio. So basically, strategy is we take the last n candles and to define a significant price movement, let x be a number and that percentage of ATR. So there will be an absolute like lowest level and the highest level in the last n candles. If the absolute difference between them is let's say some X percentage of ATR, we say that this is a valid movement. There was some battle between bulls and bears, and if something is going in like in same direction or reverse direction, it is like kind of signifiable, and we can take trade in that direction. So for index future, we are going with n is equals to 10. For the stock, it will be 15. Again, I am not mentioning any time frame here. Because this strategy works in most of the time frames, it works better on the longer time frames like the weekly and the daily, but also on 15 minutes this strategy works. So I didn't mention in time frame. So strategy goes like check the difference between the highest and lowest closing price in last 10 candles, and if the absolute difference between them is greater than X%, we say that yes, this is a valid recent maximum. This is a valid recent maximum. Yeah, again, when do we trade? So if the current price is above recent maximum or below recent minima with a margin of 5%, then only we take the trade. And as usual, if support is breaking, then we short the stock. And if the resistance is breaking, we long the stock. And again, the trailing stop loss comes in. So there is no point in doing just normal stop loss in this strategy. The trailing stop loss would be Z% of the ATR at the current price. And obviously, it should be always greater than Y% because many times stock go and retest the previous level. So as usual, the trading stop loss will be revised after each 10 minutes or 15 minutes. Here we are going to the 10 minutes. This price is going in our direction. So we had many issues while implementing these strategies on the platform. So we didn't have enough time to backtest with the many variables. So in the end, we finalized with X should be 50% of the ATR, Y should be 10%, Z should be 15%. Yeah, and this strategy will be basically hit the stop loss in the case of all false breakout or breakout. And for risk management, again, we didn't implement this, but we should cover our positions in the derivatives around 3 p.m. to avoid the gap up and gap down risk. And we also should not take the trades in the first 15 minutes. We didn't implement this part, but we also mentioned this in report. So yeah. And this was the one of the results we got. As I said, like we had many issues running all the backtests. Only like we could get 1 or 2 successful return. And this was also not run for the full part. As you can see the dates mentioned there. This was the one of those screenshots we took in earlier parts. So yeah, that's it. Hello.
Is that the end of your presentation?
Yes.
Okay, so you formulated the hypothesis, but you couldn't test it because of what?
We tried to create a code. We, as you can see in the report, also we attached our code. The ATR function and the trading stop loss we implemented, but the things we didn't implement it the 3 p.m. closing and the first 15 minutes avoidance after the market. And we couldn't test this because like many times we tried to run on the blue shift platform, but like it always like many times it ended with the graceful exit and some other errors. Only one or two times it did successfully run. This is the one of the screenshots we had. Because this is the only one screenshot I got from my coding team.
Okay. So you had some difficulties in coding the strategy and also some difficulties in running the strategy.
Yeah, basically we wasted most of the time in back testing because we expected like there was issue from our side, so we tried again and again, like we wasted most of time there, so we didn't get enough time to code for the next parts. So sorry about that.
Assume that you have coded the strategy correctly and it ran fine.
Okay.
What sort of things will lead you to reject or accept the hypothesis?
The X, Y, Z parameters. So as I mentioned, the X, Y, Z is 50%, 10%, 15%. I think this could be modified. I'm not convinced with the Y part especially. The above, like I'm also, if there are index features, I preferably go like I want to go with the Y is equals to 5%. But I can't be sure unless I get back testing result.
So you are essentially testing a strategy that is kind of a breakout strategy, right?
Breakout and breakdown based on support and resistance. Yes.
Yeah, breakout in either direction.
Yes.
How would you test whether a breakout strategy works?
Yes, as mentioned here, if after the
so suppose your strategy gives you some say 15% annualized return. So what do you say that is the null hypothesis rejected or accepted?
In this case, if you are only running on, I preferably try to run on derivatives, so this would be rejected for me. Because
sorry, why would you reject it?
Because I have used this strategy and I personally know that the potential of this strategy is from 35 to 40%. But the trading frequency would be very low. We had to add a few more parameters.
So how would you test it? You got my question, right? How would you test it? So what are the things that we'll look for in the results to say that I can reject or I can accept?
I didn't go to the like thinking of the XYZ through the back test. So it's hard to tell how exactly I'm going to do because the first thing I have in mind is I need to play with the XYZ. If I'm done playing with XYZ,
do you have a statistical background?
Yes, I have statistical courses in my BTech.
Okay. Have you heard of the term called overfitting or p-hacking?
Yes, I have heard of overfitting.
So do you think that to test the hypothesis, you should vary the values of X, Y, and Z?
Yes, I think so.
Do you think that it will not introduce bias in your testing results because of overfitting?
It will introduce a bias, but if overfitting over like
so suppose you come up with some values based on say your past experience for X, Y, and Z, and you test it, and the annualized return says 20%. Okay. And you think that that is not good enough, then you keep on changing X, Y, Z and all that, and finally come up with a particular set of values for X, Y, Z so that your annualized return is 60%. So what will be your approach in these two results? Which one will keep, which one you will reject to prove or disprove your hypothesis?
I should not go with 60%. If it is more generalized, then I can go with like. If
sorry, I missed it. Can you repeat? Which one you will keep? Which one you will reject?
If I am running like I am getting XYZ for a particular stock as 60%, then probably I will reject because it's just running.
No. My question is that for a particular stock or for a particular basket, you have ran many tests and figured out that for this particular value of X, Y, and Z, I get the maximum return, annualized return, that is 60%. And the other was you chose some values based on your past experience and came up with the returns of 20%. Between these two, which one will choose to accept or reject your hypothesis?
The one which we had better results.
Better results.
Yes.
Okay. Thanks. Varun, do you have any question?
No, Pradipta, no more questions from my side.
Okay, cool. I think we can move on to the next one. Just give me 15 seconds or so.
Team 11, you can till then set up your screen sharing and we can begin once the team is ready. Yeah, you have raised your hand, Team 11. Okay, so there'll be two buzzers that will ring, one at the 5-minute mark and one at the 8.5-minute mark, and your time limit is 10 minutes. We'll begin once you get a go ahead from the QuantInsti.
Yes, let's start.
Good afternoon. We are Team 11 and we will be presenting our hypothesis on price action based strategies on Indian financial market. We will be presenting two hypotheses. Firstly, on equities and secondly, on futures market. Let's quickly go through the workflow of the hypothesis. We start with defining our hypothesis. Then using a machine learning based framework, we select our trading universe. Then we use insight from modern portfolio theory for position sizing. Next, we devise a strategy based on pivot points and momentum based technical analysis and follow it up with statistical tests for our hypothesis. And then finally, we analyze our results and conclusions. Now to the statement of hypothesis 1. Breakouts identified by V-bottom chart pattern augmented with candle-based momentum signals work effectively on equities that are on a strong bullish trend. To predict the returns of the possible high momentum stocks for our portfolio, we have devised a machine learning framework. We explain the process with an example. Suppose we are trying to select a universe for the month of July. In that case, we extract the stock for 2 months back, that is the month of May, from the stored data, and then use the returns for the last month, that is June, as the dependent variable to train a random forest regressive model. In the next step, we first extract last month's data from the pipeline and then sort it by ADX values to get the top 100 high momentum stocks. The same data is also saved to the stored data frame and will be used to train the model for the next month. Now we use our model to predict the performance of these top 100 stocks for the current month, which is July, and then select the top 10 among these.
Building upon the above slide, the top 10 performing stocks are obtained using the algorithm that makes our universe dynamic, which changes every month. To allocate capital among these 10 stocks, we use the sequential least squares programming optimizer, which gives us the weights for getting the maximum Sharpe ratio for our portfolio. While we are using the machine learning model and its indicator-based features for universe selection, our strategy remains purely price action, as we will see on the next slide. Here, we aim to trade breakouts following a V-bottom chart pattern. We do this with the help of pivot points on Heikin-Ashi candles that help to identify the trends more accurately. As shown in the figure, the V pattern is confirmed in our strategy when the prices reaches almost at the same level as pivot 1, making a V-looking design. A conservative way to trade on such a pattern is to take a long position post-breakout. To take apt trades for the strategy, we combine it with a pattern-based short-term momentum signal. In this, we check if the present close of the Heikin-Ashi candle is greater than the previous close, and if the difference between the present close and the previous high for the traditional candlestick is positive. If these conditions meet, we send a buy order for the stock. We understand the strategy has some challenges. In consolidating markets, we can incur losses due to false signaling, and our strategy is sensitive to sudden news or disruptive market events that might hurt the performance. Hence, we put the stop loss at the low of the previous candle. This way, we limit the losses to a minimum in case of false signal. Also, to avoid stop loss remorse, we restrict the minimum stop loss to 0.5%. The target price is set at a point where the profits equal the price difference between the trade entry price and the pivot point at which the the bottom pattern was detected, as we can see in the figure as well.
We test the validity of our hypothesis using the one-sided Kolmogorov-Smirnov or the case test. The case test is used to check the similarity between two sample distributions. Intuitively, the statistic takes the largest absolute difference between the two distribution functions across all sample values. The one-sided case test confirms whether the values on average in one of the distributions is greater. For our first test, we compare the returns from a simple buy and hold strategy against the returns of our strategy. The null hypothesis is that both of the returns are similar. After conducting the KS test and obtaining a significance level much less than 0.05, which is the 95% confidence interval, we reject this null hypothesis and accept the alternate hypothesis that our strategy returns are in general higher than the buy and hold. Similarly, in the second test, our strategy runs first on the top 10 Nifty stocks with equal capital allocation. And then we use our random forest algo with portfolio optimization for position sizing. The test proves that the second approach gives returns which are higher in general. On the right, through our back tests, we show that our strategy capitalized well on the post-pandemic momentum, displaying around 150% returns with a 1.74 Sharpe. We also compare the backtesting results with specific components of our pipeline turned off. In the first case, we don't use the dynamic portfolio selection and instead run our strategy on a static portfolio of the top 10 Nifty stocks. In the second case, we run our strategy without using the two-candle momentum confirmation. While in the last one, we use equal weights for our stock universe and do not use the MPT-based portfolio optimization. Seeing the returns data and the Sharpe ratios, we conclude that each part of the pipeline adds some value in terms of performance.
Now we arrive at the second hypothesis. This flowchart shows our entire process from ideation of hypothesis 2 to its results and conclusion, which we explain in further slides. Our hypothesis states gaps in a financial instrument are likely to close or persist based on their direction relative to the prevailing trend, with larger gaps against the trend having a higher probability of closure and smaller gaps aligned with the trend having a higher likelihood of continuation. Before taking a deep dive into our strategy, let's have a brief understanding of what gaps in financial markets mean. Gaps are signified by a significant difference in the opening and closing price of consecutive candles. They're essentially a byproduct of high imbalance in supply and demand. These gaps can be broadly classified as breakaway gaps, continuation gaps, and exhaustion gaps. We are identifying a trade setup when we see a 3-candle system with a trend of more than 0.75 times the volatility of the instrument. Our trade is triggered either when there is a gap opening of less than 1.2 times the volatility of the ticker in the direction of the trend, or when there is a gap opening of more than 1.2 times the volatility of the ticker against the direction of trend. For example, if there exists a 3-candle uptrend and there is a gap up greater than our threshold, then we go long. And if there is a gap down of more than the specified level, then we short the future. The underlying logic here is that an uptrend signifies that buyers are dominant. So if there is a significant gap down, then sellers will book their overnight profits, leading to a higher buying pressure, which will cause gap. While if there's a small gap up, then it shows that the market still has a confidence in the upward movement. Coming to our universe selection, we are trading in Nifty and Bank Nifty futures primarily because it gives us higher liquidity, lesser exposure to market manipulation, lower margin requirements, and transaction costs. Also, since our strategy is a long short strategy and we can't carry our short positions in stocks, therefore it was not feasible for us to undertake trades in stocks.
In this strategy, we are analyzing the trend strength by decomposing a 3-candle system and seeing if the movement has been more than 0.75 times the volatility. The gap threshold is 1% because mathematically it gives us a 77% confidence level. Our risk to reward ratio is 0.8. We are calculating the daily volatility and multiplying it with the risk appetite of the trader to determine the appropriate stop loss. Moving on to the failure circumstances, the first figure shows the scenario when price is moving in a fixed direction. We can see that the strategy performed well and achieved decent returns and Sharpe ratio. However, in the next figure, we can see that our strategy can fail in a sideways market. Additionally, our strategy is vulnerable to new information inflow that can dramatically alter the market sentiment overnight. Now coming to the hypothesis testing of our strategy, our hypothesis states that the returns of our strategy on trending markets are of greater value than on consolidating markets. We have used the KS test and set our accepted significance level at 0.05. The in-sample and out-of-sample p-values obtained were 0.006 and 0.008 respectively, which is much lower than our accepted significance value of 0.05. Thus, we reject the null hypothesis in the favor of our alternate hypothesis. Also, using a strategy, we obtained annual returns of 78% and a Sharpe ratio of 1.998 on in-sample testing, and annual returns of 178% and a Sharpe ratio of 1.61 on out-of-sample testing. Our trading assumptions are as displayed on the screen. Since our order size is small, we will consider price and trade slippage to be on the lower end, that is 0.03%, and proxying for bid-ask spread, we add 0.01%. Thus, we consider our net slippage to be 0.04%. We have considered a transaction cost of 0.125% and 0.015% for equity and futures contracts, respectively. With this, we end our presentation. Thank you.
Thanks, guys. This is pretty impressive. One question: how did you guys find the V bottom pattern?
Right. Could you please go to appendix section? Sir, so to identify the V pattern, what we did, we had a 10 hours look back period. In that 10 hours look back period, we were looking for the change of directions. If the direction is going upward and then there is a change in the direction, top point would be identified by our strategy. A maximum point would be identified, and that is named as a pivot. Again, if the direction from the top pattern, from the top goes again to the bottom and goes up from bearish to bullish sentiment, then again a pivot point is identified on the direction change. When these direction points are identified, the length of it is calculated. If after the direction changes from the second pivot point, it reaches to 95% of the price level, then the V bottom is confirmed in our strategy, as you can verify in the code as well.
Okay, got it. Do you think some issues with this algorithm? Can you spot something? Suppose the stocks is just going up, down, up, down, up, down.
Right. As you mentioned in the failure considerations as well, that whenever there is a sideways market, there might be a problem for the same. To account for that, what we did was to put a momentum signal at the breakout point.
No, so
if we get the momentum signal, then we trade on it.
Let me stop you. So do you think it's a problem with the strategy, or is it a problem with identification of V bottom?
It is not exactly a problem in either of the sense. Sometimes in a sideways market there's a problem for the same. We could have done a trend. We could have put a trend indicator as well. While we were restricted to put some indicators in the strategy, what we did was to put a momentum-based signal. And again, if the momentum-based signal gave us the confirmation, we took the trade upwards.
I think I think what you got here is, if you work on it, this is a publishable material. So you should focus on more on how to improve your identification of the patterns.
Definitely.
And also probably expand to other patterns.
Definitely.
And reduce the rest of the complexities a bit, so that you focus on a particular aspect rather than trying to come up with a winning strategy. Cool. Varun, do you have any question?
No questions from my side, but I just want to appreciate the team for the effort.
Okay. Thanks, guys. So we can move on to the next, but we'll just take a while before we do.
Thank you, sir.
Sure. So the next team is team 23. So you can set up your screen sharing. Hi, team 23. Can you start your screen share?
Yeah, we are just starting our presentation. It just we are having some internet issue over here. Just give us a minute, just.
So you'll be given a buzzer at the 5-minute mark. Sorry. Sorry. And at the 8.5-minute mark.
Sure. Let's start.
Yeah, we can start.
Okay. So yeah. Yeah. Omkar, next. Yeah. So this is our hypothesis. So when we talk about double bottom pattern, we kind of know it's a reversal pattern and usually find in longer time frame. And even if we use it for intraday, it is likely to fail. So what our hypothesis says, like we basically are testing our double bottom pattern, but we augment it with pattern, augmented W pattern with RSI to come to this hypothesis, which you can see here. Yeah. Omkar, next. So explaining our strategy here, you can see double bottom pattern, which is W pattern, and RSI is increasing similarly. Similarly, on the right side, you can see there is another W formation, but it failed because it was not confirmed with RSI. So here you can see that in intraday itself, if our pattern is not confirmed by RSI, then it is likely to fail. Next slide. So what is W pattern or double bottom pattern? Understanding double bottom pattern, there is two troughs at the same level and a moderate rally between it and then breakout. Next. Yeah. So coming to RSI, here you can see what are the basis of calculating RSI. It is a momentum indicator which is used in technical analysis.
But you can skip this part.
Yeah. But what I want to make you understand that we don't want to go on the mathematical formula. We just want to understand the significance. So on the next slide, you can see, yeah, even though price is at the same level, what RSI is telling that relatively the strength of the price is increasing. That's why we are initiating buy. So here you can see the example which we are having. Previous example was on Bajaj Finance, and this example is in SBI. And the first example which I showed you was of Reliance. Next slide. So yeah, coming to the target and stop loss. So what usual convention is that target is kept after the resistance breakout. But what we are doing, we are taking target before the resistance, just after the second bottom is formed, because it is most likely, it is more likely to follow the prior trend. So to capture a minor pullback, we are just doing this trade. We are just increasing the number of trend, and this is what we are concerned with in this strategy. Next. Now moving over to Omkar for telling how this has been implemented.
Yeah, so about detecting the double bottom pattern. So the thing is that first of all, we identify pivot points. So pivot points are basically maximas and minimas, but not all maximas and minimas. We consider some threshold, which depends on the trading frequency you're working with. So for 5 minutes, we consider the threshold as around 0.5%. So if there's a change in the price of the stock of 0.5% or more, then we consider it as a significant change, or if it is less than that, we consider it as a mere fluctuation. So the pivot points are calculated based on this threshold. So once we have we keep on identifying these pivot points, and to identify the double bottom pattern, all we need at any point, all we need is the previous 5 to 6 pivot points. So we check for them, and if both the minimas we find, if they are near around the same level, we can confirm that it is a valid double bottom pattern. That's about it about identifying the W. Yeah, about this, that why do we require that threshold, and why we don't use all the local maximas and minimas? It's quite obvious, because we don't want to consider all the fluctuations that occur in the market. So that's why we have that's why we consider threshold to get our pivot points and not get all the local maximas and minimas. So yeah, for the RSI now, So instead of if someone was just trading based on simply double bottom pattern, they'll first identify the whole double bottom pattern and then trade at its peak, like when the double bottom pattern ends completely. But what like adding RSI allows us to do is that we can simply as soon as we identify our the second bottom, even if the double bottom pattern is not completed, but we still have both the bottoms, we can end the RSI at both those points. So we check the RSI at both the bottoms which we found, and if the RSI is increasing throughout, if the RSI at the second bottom is more than the RSI at the first bottom, we can successfully say that we can surely say that there is a trend, there is a reversal of price. So we can order a buy here, and then we can target our sell at so the peak of the double bottom. We can target our sell at that level. So that's basically the role of RSI here. It basically confirms our trade. Obviously, if the RSI is falling or it's not increasing, we don't obviously buy. So yeah, Anshuman, go ahead with the results.
Yeah. So here you can see the result in case of Infosys. So here our capital is not distributed to multiple stock. There is not any particular reason why we chose this particular Infosys stock only, not other stock. It just we want to means in a single stock we want to verify our result. So this is what happens in the case of Infosys. Next. Yeah. Next slide, Omkar. So when we distributed our capital to multiple stocks, here what we got the result you can see. So you can see the stock which we consider are from very different category, like TCS and Infosys are from IT sector, and SBI is considered as PSU as well as banking, and ITC is FMCG, and ONGC is oil. So we try to distribute our stock to multiple means stock consideration to multiple sector. So this is what happened to yeah. So assumption was slippage is negligible as we are considered Nifty 50 stock, and we haven't taken leverage in our trade because some of our trade was going for more than a day. So considering Indian market, trades aren't eligible for leverage, and rest of the cost like brokerage and STT we considered is because most of the people are into discounted broker. So we considered what Zerodha and stocks are considered. Next. Yeah, so these are the team contribution. Thank you.
Very interesting presentation, guys. So, based on this, do you reject or accept the hypothesis?
Yes, so we accepted this hypothesis. We are not rejecting hypothesis.
Why?
Yeah, because as our backtesting is showing us a good graph, like it is increasing, and it shows that usually if we are going for RSI, then trades is more likely to be profitable comparison to what normal double bottom pattern.
So your first graph is very impressive, but as you
Omkar,
see,
can you take us to the first graph?
But as you see in the problem statement, that is not acceptable, right? Because we mentioned that it has to be based on either some dynamic universe or a basket, so that we can rule out overfit or something. Now, in the second graph, it is not that great, right? It
Yes, sir. Here
performs worse than the benchmark.
Yeah. Sir, here we encountered one problem. Omkar, would you like to mention that problem? Omkar?
Yeah, like about distributing our capital in various stocks and not using leverage. Hello?
Yes, but why that is a problem?
Sir, because we weren't using leverage, that was the first point. And second point was that when we are distributing our capital to multiple stocks, so it was like there were multiple trades. Like in this particular strategy itself, we punch almost like 40,000 orders because we distributed our capital like 10% to each stock, you can say. And in order to maintain that 10%, there was always order was placing. So due to this, you can see that there is much variation in our this particular graph.
Okay, so I think you couldn't write a strategy where you are sending orders only on the signals,
But
Yeah,
you are
right.
also sending orders for this percentage rebalancing.
Right. So
Okay,
this
so
that is
that
why.
means your second thing is not actually testing your strategy you wanted to, right?
Yeah.
But let's assume that you have correctly coded it the way you wanted,
Okay.
right? And you got this results. So would you accept or reject? So your hypothesis is double bottom patterns are more effective with RSI.
An augmented. Yeah. So sir, in order to check that, we have to go for a naked double bottom pattern in order to accept that hypothesis. Because comparing
Sorry,
with
can you repeat that? What you need to do?
Yeah. Yes, sir. In order to accept or reject the hypothesis, we need to compare it with vanilla double bottom pattern.
So why you haven't done that?
Yes,
Any reason?
yeah, we were actually trying to do that. Here you can also see that in our result, the time frame of consideration is from 2017 to 2023, which was not in the problem statement, because we were trying to run our backtest, but it was getting queued only. So that was one of the reason why we didn't include it in the hypothesis.
Okay,
means
fine. Sounds
presentation.
good.
Yeah.
Varun, do you have any question?
So yeah, just a small question. See, Tim, can you explain how you coded or defined the double bottom? I mean, I just want to understand the code, particularly in get access to the code. So
Yeah,
and in this presentation, it's mentioned till calculation of minimum maximum. Then what? How do you define that, and how do you confirm this double bottom?
Yeah, sure. So for as we encounter every candle, we so basically pivot points are basically minima and maxima. And so let's say that I have I have one pivot point. Okay, I have this one starting point, and then I get some candles, and I keep iterating through them. And then for one candle, here we are considering closing price. So the closing price of that candle is the change between the last pivot point and the closing price of this candle is more than 1%. So yeah, it will be easier to explain if I say that this is similar to the zigzag indicator. So if the closing price is the change in the closing price of this current candle is more than 1% as compared to the last pivot point, I can consider this as another pivot point if it is going up or going down. So I can now I update this to my update this as my previous pivot point, and then I keep repeating the same thing. If the price goes further in the same direction, I'll keep updating my pivot point that way. Or if it changes its direction and the change is more than our threshold, then we get a new pivot point in the other direction.
That's fine, but how did you define your pattern then after you finding pivot points or minimum maximum?
How do I define what exactly?
How did you define your pattern? I mean, you define a pattern and then you take entries, right? Like if the pattern is there and then these conditions are being met.
Okay, so you're asking that what exactly you considered as double bottom?
How did you code? So that's what I wanted to know. I mean,
yeah, sure. So now I have pivot points. So at any point, if I want to check if that if I'm standing right after a double bottom pattern, I'll just check for last 1, 2, 3, 4, 5 pivot points. So
you just define a sequence of pattern points and then match whether the pattern is satisfying that or not. Okay, that's pretty much it from my side. So
I think that will work, but only problem is that the way you are identifying the pivot points, there is no guarantee that you will get alternate maxima and minima. You can get back-to-back 2 minima or 2 maxima. So blindly taking 5 last points may not work for you. Have you considered that? I think some communication issue maybe.
Team 23, can you hear us?
Let's go ahead. to the
Okay,
next team.
sure. So I think the next team is team 45. They are the second last team to be presenting. So team 45, can you start your presentation, screen sharing?
Yeah, we'll just start the screen sharing.
Yeah, you'll be given two buzzers, one at the 5-minute mark and one at the 8.5-minute mark, and you can begin.
Can you please confirm if the camera is visible to you?
Yeah, we can see the screen.
No, the video of the participants.
No, we can't see the video.
Okay, fine. I think that's fine. We'll just continue.
Yeah.
Okay, so good afternoon, everyone. We are team number 45, and the hypothesis that we have devised for our research report is a gap up opening and the possibility of trend reversal indicating favorable outlook among investors are strong indicators of successful trading outcomes for stocks having a high volatility. Now, this hypothesis was tested on a universe of 20 high volatility stocks using a long only strategy, and its effectiveness was evaluated using various metrics over the backtesting period of 3 years. Furthermore, we also expanded the study by examining this hypothesis on the Bank Nifty index through a long short strategy which utilizes futures contracts. Now, throughout the report, we have used various terms, keywords, which have been defined in the upcoming pages, such as price action, candlestick, gap up opening, volatility, trend reversal, and annual volatility.
Coming to the selection of the universe, we chose the top 20 most volatile stocks from the Nifty 500 index. The data was collected from a period of 2017 to 2021 and was divided into two segments, a look back period from 2017 to 18 and a backtesting period from 2018 to 2021. This is done to avoid overfitting on the backtesting period. During the sample period, various economic events like 2019 elections, COVID-19 caused fluctuations in the market, but our strategy maintains its performance during this period.
The strategy aims to extract profit margins from rapid price changes in equity markets by analyzing the market sentiments. To manage risk, the strategy uses a stop loss of 3%, trailing stop loss of 5%, along with a profit booking measure of 15%. To make the simulations realistic, we include transaction charges of 0.3% and along with a brokerage fee. There's also a slippage of 0.002%. The strategy opens long positions in two scenarios. First is gap up opening, as it represents a highly bullish sentiment in the pre-market scenario auction. The second is if the first line candle has a body length greater than 1%, followed by a green candle with body length greater than 1%, similar to that of tweezer bottoms or the later part of 3 inside up candlestick formations. To square off positions, the strategy analyzes momentum breakdown with the help of a red candle or momentum slowdown with the help of a bearish doji star. A bearish doji star is a formation in which the first candle has a body length greater than 1% and close greater than open, followed by a doji.
Before we begin with the hypothesis testing, we try to optimize the trading strategy on the given backtesting period by varying two parameters, the risk factor and profit booking. The risk factor is defined as the percentage of the total capital which is invested in each trade, and profit booking is the maximum profit which can be reached before the position is squared off. This gives us 20 tests and also gives rise to a problem called the multiple testing problem. It may happen that we are working with an ineffective strategy, but the right combination of risk factor and profit booking gives us a very outstanding results, purely out of chance. To deal with this problem, we use the Bonferroni test. The p-value was changed, the significance level or the threshold p-value was changed from 0.05 to 0.05 divided by the total number of tests, in this case 20. Our p-significance level for this experiment is therefore 0.0025. We have used the Sharpe ratio as the evaluation metric, as it is already available in t-statistic form, and it also combines risk and reward to give us a comprehensive assessment of our strategy. You can see the results of the various testing combinations in that given table. The rows highlighted in blue are the testing combinations which yielded the top 3 Sharpe ratios. The null hypothesis for this test is the strategy lacks a discernible advantage. It is derived from a normal distribution of strategies with an average Sharpe ratio of 0. The alternate hypothesis is this strategy possesses a strategic advantage. It is derived from a distribution with a Sharpe ratio greater than 0. All the testing combinations pass our test. That is, the null hypothesis can be rejected. In the limitation section, we found out that the false positive rate of our test is 23.62%. This means that there is not a 100% guarantee that the null hypothesis can be rejected.
Okay, now in the abstract strategy testing portion of the report, we have evaluated the performance of the trading strategy on various commonly used metrics. We shall first be looking at two ratios, namely the Sharpe ratio and the Sortino ratio, which are both measures of the risk-adjusted returns that the strategy provides. The Sharpe ratio comes out to be 2.43 and the Sortino ratio comes out to be 4.09 for this strategy, both indicating high levels of returns for the given level of risk. However, an important thing which must be kept in mind is that Sharpe and Sortino ratios are based on the underlying assumption that the returns that the strategy produces follow a normal distribution. To further analyze this, we looked at the kurtosis and skewness of the strategy's distribution of returns. The kurtosis, which is a measure of the occurrence of outliers in the tails of the distribution, comes out to be 4.71, a positive excess kurtosis. And the skewness, which indicates the asymmetry of the distribution with respect to the mean value, comes out to be 0.67, which is a slight positive skew. Both of these indicate that the returns distribution deviates from the normal distribution, and hence the Sharpe and Sortino ratios may not accurately depict the risk involved in the strategy. In order to overcome this, we have considered another important metric known as returns over maximum drawdown. For this strategy, it comes out to be 10.08, which is significantly higher than the industry benchmark of around 2 to 3. These are the final results which are produced by the trading strategy. We have obtained annual returns of 32.11% with a cumulative return of 126.28%, significantly outperforming the Nifty 50 benchmark.
After running the strategy on the top 20 most volatile stocks, we ran them on the 20 to 40th most volatile equities and the 40 to 60th most volatile equities. As the volatility of the underlying equities decreased, the performance of our strategy was also reduced. This is evidence in favor of our universe selection, which states that the strategy works well on highly volatile stocks.
The strategy stops trading after 3 p.m. to save unwanted triggers caused due to the intraday squaring of pan. This concludes the equity segment of our report. A collective conclusion for both equity and futures will be discussed in the end.
The scope of our strategy extends beyond the equities markets and includes the Bank Nifty index where futures contract. It comprises of 12 most liquid and highly capitalized banking stocks, making it an ideal primary index for our hypothesis. We chose Bank Nifty 1 over Bank Nifty 2 because of its more volatile nature.
The strategy for futures is similar to that of strategies of equity, except it doesn't use a trailing stop loss of 5%, as the volatility of futures index Bank Nifty is very less as compared to our equity volatile universe. Also, this future strategy deals with both long and short trades.
The hypothesis testing for the futures section is almost the same as that for the equities section. The difference is that the number of tests have been reduced from 20 to 5. This is because the take profit percentage, the changes in take profit percentage were not affecting trading outcomes at all. In these tests, the threshold p-value or the significance level for this test would therefore be 0.05 divided by 5, which is equal to 0.01. In this test, all the testing combinations fail the test. But it must be remembered that the test we are using, the Bonferroni test, is quite stringent, and it may be possible for some testing combinations to make it through the home test or the BHY test. The table shows the results of the various testing combinations. The following section will work on the testing combination highlighted in blue.
The abstract testing for the Bank Nifty futures strategy works on the same metrics which we use for the equity performance. The Sharpe ratio for this strategy comes out to be 1.71 and the Sortino ratio comes out to be 2.65, both indicating fairly high levels of return for the given risk level. One thing which must be noted is that both of these ratios are less than their counterparts for the equity strategy, which can be attributed to the fact that the volatility of the Bank Nifty futures is less than that of the equity universe that we selected. The kurtosis and skewness for this strategy returns come out to be 6.38 and 0.14, indicating a deviation from a normal distribution. Hence, we have again considered returns over maximum drawdown, and for the future strategy, it comes out to be 10.85. These are the final results produced by the strategy on the Bank Nifty futures, with annual returns of 45.03% and cumulative returns of 197.5%.
In conclusion, after taking into consideration all of our tests and the limitations of these tests, we would say that our hypothesis is correct. Potential improvements in the strategies in the equity section could be integrating volume analysis, which would give traders a more comprehensive understanding of market sentiment. In the futures segment, the practical returns on the futures market would be much higher if leverage was allowed. Leverage of around 5 to 10% would exponentially improve results. With this, our presentation comes to an end. Thank you.
We'll be taking questions now.
Very good effort, guys. For these two sets, for the equities and the futures, can you summarize the conclusion whether you reject or accept the hypothesis?
In the equities section, all of our testing combinations passed the test, so we rejected the null hypothesis. However, in the futures section, all of our testing combinations failed the test. So in the second case, we accept the null hypothesis. However, it should be remembered that the test we are using, Bonferroni test, is quite stringent.
How you identify the trend reversal?
Basically, we identify trend reversals with the help of candlestick patterns. That is, visa bottom. First one, it turns from bearish to bullish trend. That is the first candle length of red has greater than body 1%, and the second is a bullish candle, that is green candle, with a body length greater than 1%. This represents
how you came to this numbers, 1%, or even the stop loss of 3%, those numbers?
Yes, sir. So in equity markets, 1% change from open to close is quite significant to recognize a trend or a trend reversal, and integrating them with frequently occurring and efficient candlestick patterns can result in efficient recognition of trends. And for the stop loss, the 3% stop loss is in par with the industry standards of 2 to 5%. But we are dealing in a highly volatile universe where small stop loss can neglect the trend reversals and may lead to unwanted triggers, just degrading the trades. But a trail of more than 5% will lead to unusual losses, and at that time the chances of trend reversal also become
How
quite
did you guys come to know about this Bonferroni test or the Harvey paper?
I actually read the entire paper. That was the
How did
main
you come
base.
to know about this? Was it part of your curricula or something?
It was not a part of our curriculum. When I saw the problem statement, I realized that the hypothesis testing part would be an important part. So I was researching on various methods to statistically evaluate trading strategies.
Cool. Okay. Varun, any questions from your side?
No, Prit, no questions from my side. And good work.
Okay. Thanks, guys. We can move on to the next one, but I just need a moment before that.
Yeah, sure. Team 51, are you ready?
Yeah.
Yeah, so you can just start your screen sharing in the meanwhile.
Dhruv, could you share the screen, please?
So you'll be given two buzzers, one at the 5-minute mark and one at the 8.5-minute mark. And this is the last presentation of the day. So you can begin once you get a go ahead from
Let's start.
Can anybody confirm if I'm audible?
You're audible.
Yeah. Hi Pradipto, hi Varun. This is Jivesh and this is Team 51 presenting our version of efficacy of price action trading strategies in the Indian equities market. Dhruv, please go next. So our hypothesis is a pretty simple hypothesis because we figured that we only needed a price action sort of a strategy. So we didn't try to include any sort of technical, sentimental or fundamental analysis in it. So we have basically combined uptrend and downtrend trading using and allied waves to and our hypothesis is that a combination of uptrend and downtrend trading and allied waves can be used to make consistent profitable trades in the Indian energy sector.
So we have chosen a specific sector, and why we have chosen it, we'll be figuring out next.
Okay, so why did we choose the energy sector as a universe? So there are a lot of reasons for it. Some of the reasons that we chose it was that it's basically been impacted by the geopolitical and economic reasons, and the energy market is basically known for a lot of cycles that it undergoes, primarily boom and bust cycles. And apart from that, it is another segment in which generally price action traders can profit off from the market. Next slide. Okay, yeah. So in the context of the Indian equity market, the Indian energy sector is impacted by a lot of various factors, be it international politics or government policy, supply chain demands. And it also has implemented a lot of strategies and policies to strengthen the sector. And as per the given dates, between 2018 to 2021, it also faced a lot of cycles. That is why we chose to target this segment. Next slide, please. Yeah, so the sector saw a lot of substantial growth in the period that we chose it for. It saw a lot of geopolitical and monetary events, and the boom and bust cycles of the energy market is occurring. And however, we predicted that it might not be the same in the upcoming years, but for the 2018 to 2021 period, it did hold up. And next slide. Yeah, so the stock universe was primarily we selected large and mid cap companies from the energy segment, resulting in 7 stocks, which are listed below. Next slide. Yeah, so the tools that we use for detecting price action. We primarily use the Elliott waves. This is just some context for Elliott waves, that it's primarily a price action method. It can
yes, we can skip this part.
Yeah. Next slide. Yeah, so there are a lot of uptrends and downtrends for that, and basically, like, we aim to capture all of these points.
You can skip the
next.
theoretical part of Elliott waves.
Yeah. Next, Akshay. Yeah.
Yeah, so I'll try to explain the trading strategy which we devised. So as my team member explained, that we'll be using a combination of price action trading, such as Elliott waves, and the uptrend and downtrend trading. So first we'll try to detect the number of Elliott waves. Since Elliott wave as a theory has a strong mathematical basis, so it is bound to be more accurate. However, detecting number of Elliott waves in a given time period is quite difficult, and the number of Elliott waves will be very less. So meanwhile, we don't have an Elliott wave. We try to make one trade per day based on the uptrend and downtrend. Otherwise, once an Elliott wave has been detected, then we make use of the Elliott wave theory. That is, a market is supposed to behave in a cyclical manner. That is, there will be 5 impulse waves and 3 correction waves. So we can make one trade per cycle to make a profitable trade. This kind of strategy takes into account a number of factors, such as the consumer behavior and the cyclic nature of the market. This nature is more prevalent in the Indian energy sector, as described by my team member. Can we move on to the next slide? Along with the trading strategy, we took into account a number of risk management factors and a few assumptions. So there are a number of intermediate costs involved while trading of equities. So this includes brokerage fees, security transaction tax, stamp duty, maintenance charges, etc. Since we're focusing on Indian energy sector, we assumed an STT of 0.05% for buying and 0.1% for selling, which is coherent with the actual tax levied by the government. For sake of easier analysis, we assume all other kinds of intermediate taxes and charges to be zero. Similarly, there is often a slippage, that is the price difference between the actual trading price and the expected trading price. For sake of easier analysis, we again assume the slippage to be zero. Can we move on to the next slide? So now I'll describe the risk metrics which we considered while implementing our trade. So we considered majorly two risk factors, that is stop loss and take profit. So while trading on Elliott waves, if our price fell below 1.5 times the corresponding trough, then we stopped trading. This was to make sure that our trade does not suffer much loss. Next, we also implemented take profit, which is that once the price value rose above 1.5% of the corresponding crest, then we sold the stock to book our profit. Next slide. So now I would like to invite my team member Jivesh to discuss the observations and results.
So basically, we could not implement the code on the Blueshift platform due to server-based errors and our own time bandwidth reasons. So we tried an Allied Wave Analyzer, whose repository is attached in the report itself, and we used the data from the mentioned time period from 2018 to 2021 and analyzed the number of waves detected, essentially to confirm our hypothesis that whether there are any sort of allied waves detected in any of those stocks, and we found that all 7 of the stocks at least had one allied wave being detected in the 3 years of time period being mentioned. Well, the highest number of waves detected were 14. And could you please go to the next slide, Dhruv? Yeah, keep moving. Yes. So as you can see, we have detected at least one allied wave in all of the mid cap and large cap stocks of energy sector, and Hindustan Petroleum had 13 of them. So that's why we choose to go with the hypothesis, and this theory was the whole of the strategy was based on a paper, and the paper was took the data of much, like the energy sector was taken off a lot before than what the time period what we chose, and they also confirmed that they had chosen 5 stocks and all of them had allied waves. So we could obviously forward looking, it's not a forward looking method, and there could be a backward bias and as well as onset of overfitting, but we can I think we can safely assume that allied waves are said to be present in a seasonal cyclical cyclical stock system such as the energy sector. Could you please go to the next slide, Dhruv? Yes. So based on the results of the project, we can safely conclude that combination of allied waves and the uptrend downtrend trading, which is a go-to method for trend-based analysis in price action trading strategies, can be used. Also, could you go to the next slide? Also, we can combine it with various other technical indicators, because there are actually technical indicators which base themselves on the allied waves. So those would be a better, I think, a method to go with this strategy, because technical indicators take yes, the technical indicators take in the technicalities, and also if we want to add some fundamental aspects to it, it would be a great strategy pertaining especially to the energy sector. So we just want to conclude it here. Thanks a lot for listening, and the next slide would have our contributions.
Thanks, guys. Your hypothesis is very ambitious, but unfortunately, I think you guys didn't have enough time to actually do justice to testing it.
Actually, we have our mid semesters going on, and we have 3 today as well. So that was the problem. Yes. We could not do proper back testing and justifications. Otherwise, like we were sure that we were going in a very right direction, but
right. So I'll tell you upfront that you are going to get zeros for the test because there are no tests. So at the same time, so you cannot accept or reject. So it is essentially stating the hypothesis. Elitoev's identification, auto-identification is not very easy. And plotting Elitoev's on charts and looking at the subsequent price movement is a very poor approximation for strategy result. Because any kind of chart pattern is highly susceptible to look-ahead bias. But otherwise, your hypothesis is very interesting, and actually, we kept out some of the submissions purely because they are all the submissions we got were very interesting, but we kept out some of them because they are not either on price action or there was no test. But in your case, we were hoping that we would see some test, maybe outside Blueshift during the presentation, but unfortunately, that was not the case.
Yeah, we would have loved to do it, and we were
Yes.
like
So that's
looking
not a
right to do it.
problem. So competitions come and go. But this is a good hypothesis to test just for pure curiosity and academic interest. So maybe in future you will be able to code it and try it on the shift. So you can do it on the shift.
Sure,
Okay.
we'll try our best.
So I think Varun, do you have any question?
I have no questions, Pradita, but yeah, I just want to appreciate the team for selecting this particular hypothesis. And as you said, it's interesting and ambitious as well. So I hope they will, when they get time, maybe they'll try to continue this work. So, all the very best team.
Right. So we'll move on to the last one, I suppose, right?
No, Pradita, this one was
this is the one. Okay, great.
Yeah.
So I think we're done here then.
Yeah.
So I think all the presentations we heard today, and even the one that we didn't select, was great effort, given the time constraint and probably knowledge gap. Not everyone is very familiar in this in this particular area. So it was really, really impressive. Some of them stands out more than the rest, but the efforts are quite impressive as a whole. So we'll share the results a bit later.